price numbers which come in, PPIs, Producers Price Index is what it is in the US context, and that comes out later today, and that becomes an important indicator. What's added a bit to the misery is this statement by the Fed Atlanta president, who has said that he thinks that there is a case perhaps for a pause on rate cuts, and you saw that really shooting up bond yields. Bit of a jitter there. The 10-year actually topped 4.11% before sliding back to about 4.05%, where it is right now. So that's a pain. Crude prices will pull that up as well. Crude prices have largely been benign, and we'll pull up the NYMEX for you, which is continuing to be on the lower end. So while all is quiet on the Middle East front for now, crude prices are taking a bit of a breather, because inherently the kind of noises coming out of China is not increasing confidence of an economic resurgence, and hence demand increase for crude. So those very basic concerns continue. Asia, the big news for Asia this morning is the Bank of Korea actually cutting rates after 2 years. Shanghai is still down. The Chinese market's taking some time to recover, but the Nikkei is doing okay, about 0.5% up. Implied open, let's pull that up as well. For India, and it's looking like we're in for a bit of a jittery start, just about 30 points down, nothing too major. Let's start with a comment from Phuc Hin Yap, Senior Investment Strategist at Standard Chartered Bank, joining us this morning. Welcome, and thank you so much for speaking with us here at NDTV Profit. Great to have you on. Just your reading on this anxiety which seems to have come in on the pace of rate cuts. You think it's overblown, looking at 1 month's CPI data, Phuc?
Yeah, thanks very much for having me, and thanks for the question. Yeah, I think it did come out larger than expected, the inflation, but we think the disinflationary trend is still there. The component, which is the largest component of inflation, is the shelter or housing, and that is actually showing a deceleration from 0.5 to 0.2%. So we think that is in line. It's going to be driving this inflation, which we expect will then allow the Fed to do rate cuts. Look, I think the upside surprise came from some of the more volatile items, like your vehicle cost, the insurance along with that, and the airfare as well. We've seen the oil price come off, so airfare should also come off. So some of the bit more volatile components were a bit hotter than expected. But with something like shelter coming down, we think the disinflationary trend is going to be intact. So we still expect the Fed to be on the path of the rate cuts, and we still expect 2 more rate cuts this year in line with the dot plot, and then some more we'll see next year as well.
Okay. The question only is whether this sets the cats among the pigeon when it comes to people who are penciling in a series and a linear trend of rate cuts. Would you believe that is under a serious question mark now? And it may change, of course, in the future, but is it under a serious question now?
Yeah, I think we've seen one print, which is, I think people would normally try to see a few more in order to make a trend. And I say, if you look at the components, the large components, something like shelter, is something that is still in addition to inflationary trend. So that is reassuring. But look, I mean, I see what you mean. The market is pricing in a lot of cuts because, I think it has been volatile. It was pricing in much more by the end of 2025. Our own view is that we get two more cuts this year and another 4 cuts by September. So that's going to be easily 1.5% of cuts. But the trajectory, of course, is it going to be closer to 1 or closer to 2? It's going to depend on all the data prints that will come out in the future. But importantly for us, I think we look at the investors and where they stand. We think that it's still supportive of a soft landing as the Fed is able to do that. And as the 10-year yields in the US are getting above 4% now, we are telling investors it is a good time to average in to lock in the yield for your investment portfolio.
Phuc, hi, it's Samina joining in as well. We've talked about the Fed. Let's talk about what's happening in China. That's been the big talking point for the last 10, 12 days. October 12th is an expected meet in China. Expectations are there could be some fiscal stimulus coming. Up until then, metals may remain quiet. How do you play the China story? Are you long China, and are you aggressively adding incremental flows to Chinese equity markets?
Yeah, no, thanks for that. Indeed, the press conference by the Ministry of Finance on Saturday is going to be a big one. We had an earlier conference by the NDRC earlier in the week, which disappointed the market with a lack of details on fiscal stimulus. So really, the market is going to be looking for what kind of fiscal stimulus may be announced on Saturday. Look, in the near term, I think we've seen a very strong rebound, recognizing that valuations are very low. Positioning was very low. And then we've seen all this coordinated effort from policymakers driving the market higher. It ran up a lot in the near term. So there's a lot of expectations now of what might be coming next. I mean, we've got a base scenario, if you like, for the Hang Seng to be around 20,000 to 22,500. It is a wide range, but we expect it to be within that range. And if we do get a fiscal stimulus that's much larger than expected, and by this I mean something more than 2 trillion yuan. If that comes true, we think that the Hang Seng could move higher beyond our base range, even up to 24,000, depending on the kind of package that comes through. But at the same time, if there is disappointment coming down, again, the Hang Seng could weaken below 20,000. So there's a lot of expectations out here, and whether the Ministry of Finance will come up with that on Saturday remains to be seen. And we also have to see what is the shape of fiscal stimulus. Is it going to be something spent over 6 months, or 1 year, or 3 years? Right? It's not just the number, but the manner of the spend really matters as well. So what we're telling clients over 6-12 months is that stay invested in China with a core allocation. We do have a view that China is a neutral relative to global equities. So we say stay invested with a core allocation. But in the short term, there's going to be a volatile, depending on what kind of news comes through and whether we get a fiscal stimulus announced on Saturday or even later down the road.
While you're neutral China, what's the view on India? Is there any sort of biases here? Are you underweight, overweight? And if you have to turn overweight, what is it going to take?
We are overweight India. We didn't Asia Japan. We do like India. It's our favorite market at the moment. And look, I think the story that we've been seeing for the past years actually is in terms of the structural growth and how that's helping. And we think that continues. We do think growth will continue to drive the market higher in terms of earnings growth that we see. Valuation is always a concern. But in a world where interest rates are being cut, we're slightly less concerned about valuation because lower rates will be supportive of valuation. And we think that earnings is really what's going to be driving it. So India is one of the markets that we do like within Asia, Japan. We're overweight on India, and especially on the large cap stocks in India. We think that that's got a better buffer in terms of the security. And so we think that's going to be beneficial. So we do like India overweight. And then within that, especially we like the large caps in India.
Right.
Thanks so much, Fook. Great to have you on. So that's the global setup, which is, it's going to be a bit jittery till that data starts coming in as the street expects. Remember, as far as US markets are concerned, your seasonal quarterly data is also becoming very, very important, and how companies are faring this quarter becomes a key factor. What is also a key factor is China and what fund flows come into India. That's one thing to watch out from the Indian perspective. And look at the fund flows which we saw yesterday. Was not a great day, completely flat really for the markets, to be honest. But you had foreign investors continuing with their selling, 4,927 crores. I mean, October has been relentless. You're upwards of 44,000 crores at this point. Domestic investors did come in and buy 3,878 crores. Remember, your SIP numbers which came in, or your mutual fund inflow numbers which came in for the month of September were also a little underwhelming, I would say. So that is one key factor to watch out for. The other one, I would say, guys, before we get to the trade setup and the recap for yesterday, I thought this is an interesting story to note, is finally NSE coming out and making it clear that they're choosing the Nifty weekly expiry over Bank Nifty. The BSE a week ago has chosen the Sensex 30 and decided to scrap the Sensex 50 as well as the BankX. So effectively, there is no weekly banking index play for options anymore. There's an end to that. I reckon in terms of volume interest, that cuts down more than half in terms of actual where retail traders were coming in?
Indeed, but I think the bias would then move to activity back on the exchanges, so on NSE itself and the Nifty as opposed to participation on Bank Nifty. But yeah, any of those weekly trades and the volatility that you see on the Thursday in the last hour, any opportunity to make big money or lose big money now might be.
So Bank Nifty goes, and therefore
financial services goes, and mid cap also goes.
Nifty and mid cap goes.
Mid cap also goes.
Nifty also goes. I wonder, the easiest barometer on a policy day was to show bond yields and the Bank Nifty. Now that is out of the window.
No, and I think if you're a compulsive trader, you will still go trade the Nifty, right?
Yeah, I agree. But the Bank Nifty had so much of volumes on any financial activity day that kind of goes away. You know, I'm sure the regulators have thought this through, but the Bank Nifty going away, I mean, we've lived in times wherein the Bank Nifty wasn't as active.
And there was no financial services weekly Nifty from what I remember.
So,
it used to be a monthly expiry.
You just have to. You just have to. For a lot of people, I would say that they have to figure out what else to do with their time.
And their money, maybe.
Because a lot of it, if you have a propensity to want to lose money, you'll find another way to do it. but what to do with their time and where to put it, I reckon it might be not too bad for cash trades on banking stocks. Perhaps it's good times for your HDFC Bank and the likes. But the setup yesterday looked a little disappointing.
Yeah, well, the markets were in a snooze mode, like I'm calling it, and rightly so, right? There was such a big event that all eyes were on, including our eyes. So not too much happened on day trade. It was a rather day that most traders would want to forget. The Nifty ended flat as flat could get. But remember, just like every other day this week, we got a massive gap up in trade, but got sold into as we saw it. The Nifty was in an intraday range of 160 points, but could not surpass Wednesday's high of 25,234. It's at that level when the Nifty actually sold off on Wednesday. So we did not reclaim that level in yesterday's trade either. Bank Nifty closed above 51,500, so there was a little bit of a relief that came in for this trade. But once again, it did not make the intraday high that was seen on Wednesday from when the selling actually emerged in the second half of Wednesday and Thursday as well. Kotak HDFC Bank did okay. They'll have been losing 7 out of the last 8 trading days. Kotak Mahindra Bank at around 1 o'clock saw a huge spike and actually held on to those gains. We, of course, were wondering whether there was something bank specific here, but it seemed like the buying just came in on Kotak and it closed out at its day's high along with the HDFC as well. So both those banks doing okay in yesterday's day of trade and sort of limiting the cut that the Nifty could have potentially have seen if these banks hadn't participated. Pharma is after having a pretty solid September, it's been on the sell side and continues to see some selling pressure. It was down about 2% in trade across the board in pharma stocks. Stocks like DVs did quite well on Wednesday, but of course what we saw yesterday was selling pressure emerging across the whole pack in trade. Adani Enterprises saw a significant rebound in the last hour of trade, and this was largely on back of a very successful QIP launch that we'll talk about in a few minutes, but it recovered nearly 4% from its day's low, closing in at the day's high. Defense stocks did okay. After quite a few months, they've come back with a bang in some ways after the Prime Minister announced 2 significant defense deals. Apart from that, Tamanna's already mentioned about the NSE changes that came in, so that was one of the stock that markets would, BSE would be one of the stocks that the markets would be checking out. But all in all, it was a day that was rather non-significant in many ways. Apart from that, I think it was all about earnings. And TCS has reported, we'll talk about that in a minute, but what does it look like this morning? Again, a lackluster-ish Friday from the look of it.
Yeah, you could argue that because, I mean, if you just look at the last 4 or 5 days, the index has largely been constricted in this very narrow 500-point range. So you haven't seen it budge too much. I mean, people buying it at this 700, 800, 24, 700, 800 levels, selling it at 25, 200 levels. That's been the order and the magnitude of trade, and very likely that it will not go away too soon. In fact, if you look at the FI long-short ratio, it started off for the series very positively, but it's come off quite rapidly, really. So in sense, the quantum of long positions or long bets on the markets have also gotten constricted quite significantly. Blame it on the SEBI action or global geopolitics or what have you, or crude bouncing back, etc. A cocktail of everything, but certainly come off, and therefore that's something you got to watch out for. And maybe that's why the opportunities, because the Q2 earnings season has also started, shift squarely in the mid space. You probably find mid-cap stocks flying away while the index stays absolutely flat. We saw that yesterday with a few stocks as well, those whole caustic soda players, etc. So I think you probably see a lot more of that even as the index kind of meanders along and doesn't really have too much of movement. So, and I don't know, somehow I felt, we talk about TCS of course, but I don't know if IT really gives a bit of a supporting hand. It was expected that if it does the trick, maybe it will.
Has it done the trick? I think TCS is looking underwhelming.
Which is why I'm saying that IT may not really do the thing that was expected yesterday, that maybe TCS does the trick. But
no, and I think yesterday as well, IT did see some weakness in trade. So it seems very sectorial in the sense of what we are seeing. There's no fundamental reason anymore driving some of the gains and losses in counters. But TCS was underwhelming. The numbers were a miss. And it seems like the outlook also is looking extremely cautious. So apart from the BSNL ramp up, and we'll talk about this in more detail with Rucha and an analyst in a few minutes. But I think largely speaking, most brokerages, barring maybe a handful like an HSBC, don't seem very impressed by what TCS has delivered in the quarter. Revenues were down about 2.6%. EBITDA was flat. Margins were also down slightly. But this was very rare and unexpected in terms of the margin front. Net profit was up about 5%. So revenues largely in line on back of BSNL, margins and profits below expectation, and North America has seen a couple of deal losses. Now it'd be good to understand whether these are client specific losses that they've seen, or this could be an indication of what's to come over the next couple of quarters. Discretionary spending is still weak, and remember, while TCS may not carry the chunk of discretionary spending, if discretionary is slowing down, it gives us an indication that counters like Infosys, which are big grabbers of discretionary deals, will also see an impact or see an earnings season that may not be too impressive. Valuations on TCS are rather stretched, and the numbers seem underwhelming. So keeping that in mind, don't expect fireworks on Tata Consultancy to TCS in today's day of trade. Well, apart from that, we have a few more, and I've taken one from the large, the mid, and one small company to just sort of mix this up this morning. Anand Rathi delivered numbers, and these financial players have been delivering quarter on quarter. There seems to be no easing in terms of what the company has done in terms of the quarterly review. Revenues were up in line, 32% higher, 242 crores. Net profit was up 32% at 76 crores. And margins have expanded marginally. So remember, because of the base effect and the fact that this is sticky revenue for the likes of Anand Rathi, the 30% growth quarter on quarter has been visible for the previous few quarters and continues as we go into the future. So once again, a 30% growth on top line for Anand Rathi. Masscow Dogs, small company, but I like mentioning this one because they've been in the news all through early part of this year and then went off on the back burner. But the Prime Minister has announced 2 defense deals. One goes to Masscow Dogs for about 122 crores. So there could be an up move. The stock did well yesterday, was up 8.5%. Could be another morning of gains rolling in for the counter guys.
Absolutely. Okay, the 3 stocks on my radar. Let me start with Bandhan Bank. Bandhan Bank has had two pieces of news which is an overhang for the stock, or 2 details which is an overhang for a stock, and yesterday both have been cleared. So a double thumbs up in that sense. So 2 key overhangs are gone. One is the audit of their portfolio, which they had extended for, during COVID. After COVID, there were government schemes, and their emergency lending credit guarantee scheme had come under the radar. This is Bandhan Bank that I'm talking about. That has cleared because the forensic audit at Bandhan Bank by National Credit Guarantee Trustee Company is now complete, and the assessment has really gotten them off the hook in a sense. So they get some of that money back. Simply put. The second thing that is working for Bandhan Bank is their new leadership, which is coming in. That change sets in from the 10th of November, and Dr. Partha Pratim Sengupta will be the managing director and CEO for 3 years. He's groomed at SBI. 4 decades of experience between 2016 and 18. He was the chief general manager at SBI Kolkata Circle. So he's, a very experienced guy now at the helm. Both of these are looking good. Jefferies, of course, is excited. A bunch of other brokerages are excited. But I think these 2 things, and especially the overhang of the credit guarantee scheme, moving off. Remember, this is a story that NDTV Profit first broke and brought to you, that Bandhan Bank was under scrutiny. This is going to add 550 crore rupees to their balance sheet right away. So definitely a thumbs up, a double thumbs up on Bandhan. You want to? Yeah.
No, just there's one thing that it's in the FNO ban, but it could still turn out to be the stock of the day today.
Yeah.
Frankly, the news is so positive. But in the FNO ban, so mindful of that.
Yeah. But double thumbs up in any case. Adani Enterprises, they have announced their QIP on Wednesday, 4,200 crores. The floor price is set at 3,117. It's at a 2.4% discount from yesterday's close and a 6% discount from Tuesday's closing price. They're going to be issuing 1.42 crore shares of face value 1 rupee each. And Niraj, I think some details coming in. You're seeing that on your screen as well, even as we speak, on the kind of investors that have come in, the storied investors that have come in, and that's working for it, which is why we're giving it a thumbs up.
Yeah, just the small detail, the difference. I mean, one is the nature of the names. Two, it's only long only. There are no hedge funds out here. No, I mean, they haven't felt the need for HNI investors because it was a 4x demand on the book. So, with the standard disclosures, of course, but look at the list of names. Quant MF, White Oak Capital, Tata Mutual Fund. I have heard the name of GQG as well. So, a lot of very interesting names out there.
Just very quickly, in the board meet in May, I think they approved a total fundraise of about 16,600 crores, if I'm not right, so approximately 2 billion. The amount that's been raised right now is only 500 million. So they do have the green shoe option that they may go out and, of course,
they haven't exercised that yet.
They haven't exercised it yet. So it wouldn't surprise me that the same strong hands may come in and, of course, add to the offering if they exercise the green shoe option.
Yeah, but GQG, Windrow Commercial is the other name that is floating around. So pretty strong pedigreed list of investors.
And GQG has been very active in some of those very sort of hidden gems. I mean, Adani is not really hidden anymore. Yeah. It's quite the gem there. But I think, so GQG, of course, putting the big bets.
And standard disclosures here. You're watching NDTV Profit, which is owned by the Adani Group. So putting that out there with reasoning for why we've taken that call. Okay, IREDA is the third stock, and we're going to be speaking to them later this morning. Thumbs up for them as well, because the numbers are good. Strong growth continues. Profit estimates have been missed slightly, but revenue up 38%, net profit up 36%, slightly below the Bloomberg estimates, I must say. But even so, you could see a good thumbs up on the stock. The net interest income is up 52%, and GNPA and NPA numbers are also looking good. They've also had an approval for their retail business unit. So that's another piece of news that has come in. They've received that approval from the DPAM and Ministry of New and Renewable Energy. They're going to be setting up a wholly owned subsidiary for retail business. Will be engaging in rooftop solar, B2C segments, and emerging renewable sectors. Now, this could be really big because, remember, this is coming with government push to make solar rooftops more accessible. And then you have this retail arm of IREDA. We're keen to ask the management how exactly they see this panning out. But yeah, those are my three stocks, and all three thumbs up.
Yep, all three thumbs up. Pretty good list, if you will, today, in some sense. Tata Elxsi is one on my list. The numbers were okay, and just before we get in, Sandeep Agarwal of Sovilio, a very interesting name to have today, considering that two IT names that have come out. But very quickly, Tata Elxsi, revenues up 3%, almost in line with estimates. The EBIT margin left a bit to be desired, could have been better, hasn't been as strong, 25.02% EBIT margin versus estimated 25.9%, but the profit number was okay. So the quarter seemed muted, but the guidance from Tata Elxsi was strong, and thereby you might well see Tata Elxsi see a bit of a spurt, even on TCS, by the way, because it's lost 5-6% in the last 1 month. You never know if it comes up, so watch out for that one. I'll watch out for Oberoi Realty. The board has approved that 6,000 crore QIP, so that could be an interesting one, because if they're raising such a large sum, and if they have the confidence of this money being raised, it could maybe trigger a positive move there. And I'll watch out for Cipla. There is a Citi note on Cipla. And a lot of pharma stocks were in cloud yesterday for more reasons than one. But Citi is saying that a China-based pharma company has received a nod for the generic version of Abraxane. Now, Cipla has this product, the generic version of Abraxane, but the Chinese company coming in can garner both market share and lead to a decline in prices at a point of time when Cipla's supplies are not quite well known, because their Goa facility has a warning letter, and therefore the supplies are not quite well known, and this product contributed to 6 to 7% of ex-Revlimid EPS as per Citi estimates. So watch out. Cipla was under a bit of cloud yesterday. could well be some more downticks. So that's the last one on my list today, amongst a lot of other stocks which will be in focus.
Yeah, and a bunch of earnings, small earnings, but the likes of Adjustile, Reliance Industrial Infra, Plastibands, Hathway Cable will be reporting numbers today. Tomorrow you've got the big one, Avenue Supermart, that will report earnings, and we'll of course see the markets react to that only on Monday. But it is TCS that's kicked-offed the earnings season at the big one. Sandeep Agarwal, fund manager and co-founder of Saulio Investments, joins in. Sandeep, good morning. Most analysts tracking TCS seem to be slightly underwhelmed, maybe disappointed with the reportage of TCS. Your reaction to what you made of those earnings?
Yeah, good morning and thanks for having me on the show. So as you rightly mentioned that there was something which was missing on both revenue and net profit to some extent. I would not say revenue on the front of it is missing, but if you chip apart the quality of the revenue and the BSNL deal and all, then maybe there was something more wanting. And on the net profit, similarly, it is a flow down impact of that deal to some extent. But I would say that, fundamentally, these numbers also suggest that the worst is behind and things will improve from here. Number one. Number two, if you see, I'm more positively surprised with the recovery in the BFSI, and it also clearly suggests what we saw in Accenture numbers, that consultancy is down, and that is what is reflecting in North American decline, at the same time BFSI uptick. So it is, in my view, positive from the growth perspective. It seems that worst is behind and things will pick up. But at the same time, I would also say that all these stocks have run up quite a bit in last 6-8 months, and as I've said many times earlier, that this is a sector where you can make 15% annually in the large names and 15-20% in the mid and small names, depending on where you are. So I think large part of the returns for near term are behind. So while numbers will improve from here, and there will be more surprises to come on the margin front, but the upgrades will be limited, and the stock price reactions will also be limited in my view.
So Sandeep, hi, good morning. Tamanna here. Stock price reactions will be limited, you're saying, on the downside? And then in terms of what you're expecting from the other major IT companies, let's say compared to an Infosys, is this also realigning your expectations from an Infosys, or you're upgrading an Infosys compared to a TCS at this point, seeing the numbers?
No, so I would say from business perspective, all the IT companies will start showing improving numbers on revenue and margins both. It will be slower, margins will be more, but remember that the stocks have all priced in for most of the companies, and they are all up substantially in last few months. So my point is that, despite improving numbers and good outlook, the stock may not react in that way. As far as TCS is concerned, I think the numbers, because they are slightly below estimate, and the quality as well, so the stock may see some pressure. But again, I would say that, it is a stable company, good dividend buyback, so you will not see extreme reaction on either side. Same thing, I think Infosys is up quite substantial in last few months. So again, in Infosys also, with all, even if there is a positive surprise, the reaction on the stock price will be limited on either side.
One quick thing, sorry, just to make it clear, because TCS has corrected 5-6% in the month gone by, if there is weakness today, my question is contra. Do you reckon that the street might buy into it as well? Because there are some who are actually saying that they are very constructive on the commentary given by TCS. So let's assume that the stock starts off slightly lower on the quarterly miss. Would you use that as an opportunity to buy a TCS if you were a tactical trader and not the fund manager?
No, so I think, these are companies which if they fall sharply, you must buy, because they will always give you return. There could be some time correction, but you will always make money, because these are very, very strong businesses, and market leadership is there. We have 96% market share in IT services of the outsourced market. So you cannot have any other such business. So in a long term, you will make a lot of money. So people, if it falls sharply, then definitely, I think people will buy it.
So that is the call on TCS. Just very quickly, Sandeep, across the sector, where would the bets be? If Infosys, of course, has the big pie of discretionary spending comes to Infi, and it seems like that is slowing down, I would imagine Infosys would get an earnings reporting which may be slightly more disappointing. Of course, Wipro, there's new management, so it's tough to bet on. Tech Mahindra, communications been weak, so that's again a problem. What is the pecking order in terms of stocks across the IT pack, across the front line and the broader markets? And while we're at it, if you want to share with us your view on Tata Elxsi as well, if you track that one.
Yeah, so since I run a PMS, I will not be able to put one stock against another, but let me put it this way. In the large cap, whatever has given substantial return in last 6 to 8 months and are fairly priced, because see, this sector is a 8-10% revenue growth and 12-13% profit growth. So the stock price appreciation should not be more than 15 to 18%. And wherever that kind of return has already been made, I think despite good outlook, the time correction will definitely be there. In the mid cap, there are two segments. IT services, again, similarly, if they are expensive, they don't do the stock price returns will be limited. But in the ER&D, I think it is a very, very structural bet. People are willing to pay 50, 60, 70 times simply because they know that next 10, 15 years, the ER&D space will do phenomenally well. And that is the reason, Tata Elxsi, for instance, the numbers are not as great. But if you see the commentary and the quality of the commentary, that is very good. And they are doing the right thing. They are trying to build the company on design-led strategy rather than anything else. So this all will pay rich dividends in the next 10 to 15 years. But having said so, in short term, this all, because they're expensive, they can all go through time corrections and, sometimes knee-jerk reaction as well.
Got it. Such a nice way to put it, Sandeep. Thanks so much for explaining it so succinctly. Great talking to you today this morning. Have a great weekend.
Thank you. Same to you.
So on TCS, the downsides are limited. On Tata Elxsi, the guidance is very strong, but because these guys are expensive, the ER&D companies like Tata Elxsi, maybe they get into a bit of a time correction, but the guidance is positive for Tata Elxsi. So those are the two result boys that we wanted to talk to with Sandeep. Now, did the FNOQs suggest that yesterday is the key question on IT and on the markets at large? Agam Johnson with that. Agam, what have you observed on the derivative side? Good morning.
Good morning. Well, yesterday was a puzzling day, to be very honest, because we were expecting a lot of volatility and we didn't really see that happening. It eventually turned out to be a flat day of trade. And moving in, what we're keeping an eye on naturally is the Nifty. Now, of course, firstly, an important update when it comes to the Nifty. The NSE has opted to keep the Nifty 50 weekly options expiries and will do away with the Bank Nifty weekly options expiry, which is going to be heartbreaking for a lot of traders. And of course, the mid cap and the financial services will also be done away with. Pardon me. But I'm going to come back to the Nifty and what's happened there. Flattish movements. The Nifty holding on to 25,000 and open interest looking at an increase of around 1%. The Bank Nifty, on the other hand, continues to see unwinding even as the spot advances by around 1%. Now, moving on, we are moving into new week. So at the moment, what we're expecting is consolidation, sideways movement, and which is why we've also starting to see a lot of writing around the 25,000 calls and puts at the moment. This also indicates that for now, traders expect the Nifty to move within a range, a tight one for that matter, where you may not see too much deviation from the 25,000 mark, at least in the near term. Moving down to stocks, it was I would say it was in the broader markets, it was that we had a weaker breadth coming in, a mixed day of trade with shorts for Shree Cement, Sun TV, and L&T, and unwinding for a lot of these counters. Let's move on and talk about those stocks which saw long unwinding. Lupin, Coforge, and Apollo Hospitals. Tata Chemicals and Lotus Labs, on the other hand, did see short covering. Mixed day of trade, more losers than those which advanced yesterday, and I'd reckon that to a certain extent we're likely to see a continuation of that trend even as benchmarks continue to consolidate going forward. But that said, let's get in an expert opinion here. We have Milan Vaishnav of Gemstone Equity Research who joins us on the show. Milan, good morning. Thanks for joining in. Let's start by taking a look at what you have, or rather what your view is when it comes to the benchmarks. How are you seeing things develop, and what kind of an option structure are you looking to deploy here?
Yes, Agam. Very good morning. Let me zoom out a bit and then speak about Nifty, because if I recall my conversations on this platform a couple of days or maybe 3-4 weeks ago, what I have been mentioning that there is a lot of deviation of Nifty from the mean, and at one point in time, from the 50-week moving average, we were trading almost 9 to 10 or percentage higher, and this kind of mean deviation is not healthy for the markets, and some sort of retracement cannot be ruled out. Now, let me fast forward to what we are seeing now at this point in time. We might be able to attribute so many reasons to the recent market downsides that we saw. That we can talk about geopolitical tension, we can talk about SEBI, tightening the FNO curves, or for that matter, XYZ, anything, any reason we can mention. But what we have seen, if I speak from an isolated technical angle, we have just seen a retracement from the mean, and we have not even tested the 20-week moving average. So I still believe that the overall major uptrend still remains very much intact. Now, speaking from a very short-term horizon, if you look at the options data, what I see is that 25,000 levels might act as an inflection point for the Nifty for the immediate short term. I'm talking about 1, 2, 3, 4 days from now on. And sustenance about 25,050 would be the key thing to watch, because 25,040 or 50 odd levels is where the 50 DMA is. 25,000 remains a psychologically important level. And also at 25,000 strikes, we have both the highest call as well as the put OI getting concentrated there. So I believe that there might be some consolidation here and there, but the downsides in the immediate short term might be limited. We might see a technical rebound before we begin to decline further if the trend continues to be weak. But some point in time, I believe that a technical rebound can be expected from now on, at least over the next week.
Fair enough, but what kind of spread are you deploying there based on your view on the Nifty then, Milan?
Yeah, I'll take a bit of a directional call on Nifty this time. I expect 25,000 level to hold by end of 17th October expiry. So I'll be initiating a bull call spread. I'll be buying 25,000 call and selling 25,500 call. It should be call. It's my mistake. We'll be buying 25,000 call and selling 25,500 call. The total premium that we'll pay would be around 151 rupees. That would be 3774. And that's the maximum loss that we would take. But the maximum profit potential is somewhere around 9,000 rupees here on this thing.
Right. All right. And I believe that HDFC Bank is also in focus for you today.
Yes, HDFC Bank has historically taken support at its 100 DMA, and this time also it is expected to bounce off. It has taken a support once again. So again, I'm initiating a bull call spread here in HDFC Bank. We would be buying 1660 call and sell 1730 call, pay a net premium of around 24.35 rupees. Here, maximum loss we can expect is 13,390, and maximum profit potential here is close to 25,000. However, we can also keep this maximum loss limited if we apply a protective stop of HDFC Bank slipping below 1600. We can exit the call if spot levels fall below 1600. Therefore, we can keep the losses even less than what is mentioned in the maximum loss figure.
Okay, well, we'll leave it at that. Milan, thank you so much for joining us and taking us through your views on the markets and, of course, giving us those two option structures to work around with. With that, it's back to you all.
All right, thank you for that, Agam, and nice to see you in festive wear as well. We're all celebrating here at NDTV Profit. Not too much of a celebration for pharma stocks, though, and we have our next conversation on that. Nimish Mehta, founder at Research Delta Advisors, joins us to analyze what's been happening with pharma stocks. To just set the context, the Biden-Kamala Harris administration has announced a plan to ensure that Medicare-enrolled patients would effectively see prices of generic drugs at not more than $2 in their list. Of course, it's an important announcement coming in before the elections in the US. Will be implemented only in 2027. But as a result, you saw the Nifty Pharma taking a huge knock. Cipla, Lupin, these were some of the worst hit on the pharma pack. Now, why is this a matter of concern? Let me start right there with Nimish Mehta's view. Nimish, very good morning to you. Thank you for speaking with us here at NDTV Profit. Let's get your take. Is this very, very bad news for Indian pharma companies, and why?
Well, it's definitely bad news, I would say so. How much bad it is obviously will lie in the details. As of now, what we understand is that this $2 is the monthly co-payment that is fixed for a patient. That really does not mean the pricing of any drug is being fixed. And at the same time, the government, I think the US government is likely to start with a list of 150 drugs. So 150 drugs is not too many in terms of the total number of coverage that one would have. So yes, it is a step in pricing, towards a pricing pressure. The most important part is that US government so far was a price taker, which means that they would kind of negotiate from whatever market prices are available. But now they would probably become price makers. So they will directly, they know the cost of what they are going to pay, and hence will try to negotiate price accordingly. So that's the biggest thing.
Nimish, so yesterday we saw Lupin that ended 6% lower. Cipla was down 3%. Torrent also fell over 3% in trade. And the drugs that are doing the rounds that could be available for no more than $2 are penicillin, metformin, lithium, and drugs for high cholesterol, blood pressure, and other chronic conditions. Which specific companies would this impact, even at the pilot level, which could be all the way out in 2027?
No, so first, again, let me clarify that this $2 is the cost of what a patient is likely to pay. This does not mean this is going to be the cost for any drug that is, a part of that 150 drug list. So it is the co-payment, so essentially the government is trying to ensure that a patient knows how much he is likely to pay on a regular basis, because these are essentially for chronic medications. And
does that mean that Indian companies could still sell it at a price higher than $2 and the difference would be absorbed by the government funds?
Absolutely. So the way it works is that, there is a co-payment, which means that the patient has to give some amount of money or will have to participate in the overall expense. So the overall expense when it comes to Medicare, Medicaid would be obviously very low. But still it was always in percentage, and hence a patient would never know what is likely to be his cost, his or her cost, if he is, say, succumbing to any disease on a regular basis, like a diabetes or a cardiovascular disease. Here, the government is trying to ensure that he or she has to pay only $2 per month for one medication, and hence he or she will know what is his total cost going to be. That does not mean the total cost being paid to the manufacturers is going to be $2. That is not likely to be like that. Also, I would like to add one more thing. I think this entire plan has been derived or devised after obviously doing a lot of research. What we understand is that within this cost limit, I think they were already hitting some 60 or 70% of the total drugs that were dispensed through Medicare and Medicaid. So it is not that it is likely to change the dynamics significantly at the start itself, but yes, because government has kind of stepped into controlling the prices, that itself is a negative in a longer term.
Okay, Nimish, so I presume that you don't see too much of downside here in terms of market share or revenues for Indian firms. There is a brokerage note which says that it could be maybe low single digits. Would you concur?
It's again, I don't know whether to put a number to it. First of all, it's not going to be implemented before 2027. That is the first point.
Sure.
So whatever is likely to, whenever it gets done. And then, as I mentioned, how much is the price the state governments are likely to pay is not. I'm not very clear, but from what I understand, not a lot many products will get influenced by lower pricing than what we pay today or what they get today, at least at the start of the plan, which is where it includes 150 drugs.
Okay, Nimish, appreciate you taking the time out and being with us. Thank you so much. It was good talking to you today, and thanks for giving that clarity as well. Now, before we talk about those flashes on the screen, Kush Bora, because Pharma was so active yesterday, we've just heard, there was fear yesterday, a lot of stocks were down. It may not be as bad, we don't know that. Are charts that negative or are charts finding a bottom?
So first up, a very good morning.
Welcome, Kush.
All of you are looking stunning. Absolutely.
Thank you.
Correct. And happy Dussehra to all of you.
The two of you. I doubt a man can compliment another man, but that's okay.
Why not? Why not? Let us, give back the compliment. All of you, both of you, also looking stunning.
Yeah, I didn't say both of you. I said all of you, right? So, and a happy Dussehra to you and to all the viewers. Well, just to come back to the question on pharma, Niraj, is actually not that bad, because if you see the pharma stocks, including the likes of Sun Pharma, Lupin, they've had a very good run. Some of them were consolidating, some were on the way up, like the likes of Sun Pharma. Now, what has happened is that with this kind of correction, some of these have actually cooled off. The froth has come off and they've come to the support zones. So I will actually, purely from a technical standpoint, look at buying opportunities in some of them. Now, I won't go out and buy immediately at 9.15 or perhaps 9.30, because the closing of some of these names was at the low point of the day, which is suggesting that perhaps there was some overhang left and could come in today. But if that doesn't happen, this actually makes a very good risk-reward ratio for a long position from these levels, at least on the likes of Sun Pharma and Lupin.
Okay. Watch out for those pharma names, and we'll talk about some of the others too. But just take a moment away from Indian markets to the flashes on your screen. To my mind, this is big because, for a Tesla stockholder as well, this is big. For the longest time, Tesla has lagged a lot of its peers. Now, this was a much hyped event, and Elon Musk has gone out and done the formal product launch of the Cyber Cab. This is the autonomous self-driving fleet of taxis, which are Teslas, of course. And this was supposed to be the big thing. Now, for whatever it's worth, and I have no Tesla shares, so a completely unbiased view here. But I seriously hope for this to succeed as well, because it's just technology taking the world ahead, right? It'll be great to have safe self-driving cabs. I know India will take a long time.
I would never sit in a self-driving cab, ever, where there's no human in control.
But Tamanna, maybe in 4 or 5 years' time, if the product proves itself, you'll be comfortable doing this in the US, maybe when you travel there. Or some other country, or some other countries, maybe in India too at some point of time. Who knows?
My only fly in the ointment, it's a two-seater. Just in terms of economics, I don't know if it makes it sense.
It's great. You have to pay $150 to travel to a US airport from New York, Manhattan. Now, if it's a two-seater cab and if it's cheaper, why not?
I don't know if it will be cheaper. But yeah, the technology, I agree.
That's the point, I'm thinking.
An algo and, a machine deciding that I reach safely.
You've had those Uber deliveries, right? Those robots delivering all over the world right now. And I don't think there have been any mishaps. Not that I'm saying we're as good as a parcel of food.
You would sit in a self-driving cab?
I'd walk.
But this is the
same. I like walking.
No, but this is the same. So just one last piece here. The same thing that has been spoken for example, deep sea diving with shark-infested waters, or airplanes. More people die of coconuts falling on their heads than those things. So, if there are 1 or 2 accidents happen, sure, it shouldn't be happening. But the rate of safety of this also might be good.
Absolutely. No, and I agree with you. I'm sure more and more people will come around.
Yeah.
We'll wait and see. With all things Tesla, that's always, the point.
Yeah,
they're ahead of the curve. They're ahead of the curve, no doubt. But, coming back to one stock which is definitely in focus today is Bandhan Bank. They've finished a review of its claims with the National Credit Guarantee Trustee Company. After adjusting for some issues caused by COVID, the final payout has been determined. Pallavi joins us with more on that. Now, Pallavi, put this in context, because this was a big overhang for Bandhan Bank, wasn't it? And a story that NDTV Profit first broke.
Absolutely, that's right. So the detailed forensic audit at the bank by the National Credit Guarantee Trustee Company has now finally been completed, and the NCGTC has assessed that the total claim payout to the bank under the Credit Guarantee Fund for Micro Unit Scheme has come in at about 1,231 crore rupees. That's for FY24. Now, what we must remember is that this revised amount considers the exclusion of certain accounts which have been adjusted from the claim. And the rationale for this that was given by the bank in its exchange filing was that it had taken a conservative approach in view of certain operational gaps because of limitations imposed by the pandemic during FY21. Now, considering that the first claim was already settled, the final claim payout is currently at about 314 crore rupees. Now, like you mentioned, Tamanna, Bandhan Bank stated statement has come in after NDTV Profit way back in February reported that NCGTC had initiated a forensic audit of loans worth about 23,300 crore rupees because of concerns about Bandhan Bank's credit guarantee portfolios. The audit had started in December 2023 and it was followed. We first had a preliminary audit that was done by NCGTC, after which it raised some issues and made certain observations and then decided to go ahead with a more broad-based forensic audit. And like you also mentioned, this was one of the overhangs on the bank. The second one, of course, being the management transition that was taken care of as well, with Bandhan Bank announcing Partha Pratim Sen Gupta as MD and CEO of the bank. The move has been cleared by the RBI, the bank said.
All right. So that is two good things happening for Bandhan. This overhang of whether the credit guarantee scheme implemented post-COVID was misused or not, this has gone away. Then you have Pratim Partha coming in as the new CEO, because who next was always the question, and this is something that brokerages are pretty excited about as well. Jefferies has maintained a buy on Bandhan Bank after they appointed the new CEO. Harsh is bringing us all the details. What is Jefferies' assessment, Harsh?
Very constructive. The commentary seems to be very positive. Target price of 240, 27% upside. Now, in terms of course, the overhang, two key overhangs gone away. We've discussed that. But the new CEO comes with a strong background. He was Chief Credit Officer at SBI for 2 years, 2016 to 2018. 2020, he became MD CEO of Indian Overseas Bank. So comes with a very strong background. The other piece is with regard to recoveries from credit guarantee scheme, of course, that adds credibility to all that Bandhan has been saying, according to Jefferies. So commentary getting vindicated. That's the positive viewpoint which Jefferies is taking from this. Asset quality expected to behave better than other microfinance institutions, and that they believe is a positive going forward. So they're seeing some bit of constructiveness on that front as well. They're expecting a 15% ROE in the business going forward. Valuations at 1.1 times FY26 look inexpensive to them at the moment. CLSA 2 has an outperform on the stock. Again, similar target price 240. They believe that the focus will now shift to fundamentals. Two overhangs gone away. They believe near-term delinquency for MFI is already priced in to how Bandhan Bank stock has behaved, and these two big pieces of news should lead to a re-rating in the stock. They believe that is warranted. They value it at 1.3 times price to book, so slight difference in terms of their estimates between Jefferies and CLSA.
We'll see you in the office soon. Kush, have you tracked what Bandhan Bank is looking like on the charts? If it's up for a re-rating, fundamentally the news trigger is positive, but it remains in the F&O band. So I'm guessing the upside may potentially be capped, but do you want to tell us what the charts are looking like?
Nothing too encouraging. I mean, if I were to draw a silver lining out of the move that has happened over the last maybe 3-4 months, it's that the 180, 185 support zone has been respected. It's been tested once again, a couple of days back, and the stock's rebounding from there. But on the way up, there are a few supply pressures. While the 190, 195 gap could very well be filled, further upside from there on could be limited. So if there is a bounce today, owing to the news, then what I would do is I would take this as an opportunity to exit if I had a trade on Bandhan Bank, not go and create any fresh long positions. Meaningful run might come beyond the 205 level, where all the near-term averages, 200, 20, 50-day moving average sort of converge. So above 205 is where perhaps we'll start considering. Up until then, this is a sell on rise.
All right, Dharmesh Kant also with us this morning, Head of Equity Research at Chola Securities. Very good morning, Dharmesh, and great to have you on. Let's start with Bandhan Bank itself, since we're discussing it, and it could possibly be the stock of the morning. Are you seeing enough of an upside there? Would you be excited about Bandhan Bank now that these two major concerns seem to be behind them?
Yeah, good morning, Tamanna. And a happy Dussehra to all at NDTV.
Thank you.
Profit and other viewers. Yeah. See, Tamanna, if you look at Bandhan Bank, from the time the transition happened from microfinance company to a bank, it has been plagued with many issues. Earlier, it was the microfinance which was having a problem because of the geographical location in which it operates, basically West Bengal, Odisha, and parts of Bihar. And secondly, the climatic, natural conditions have not been very conducive. Flooding is often seen in those areas, which creates a problem to small ticket size loans, particularly in the microfinance division and the retail division. I think having seen all that, they have now been consolidating quite a bit. And from here on, next 6 months to 1 year should see a stable phase for the Bandhan Bank. But as far as buying or investment is concerned, I don't think one should be going ahead with that. Your trading place can always be there. There are plenty more opportunities in other more stable and more, growth trajectory kind of banks which you can play out. So we are skipping Bandhan Bank for that matter. Not excited at all. But yeah, neutral to its outward visibility.
Okay. Well, thanks for that. It'll be interesting to see. Remember, Bandhan Bank is in the F&O ban as well. So that kind of hurts this. So bear that in mind. Okay, very quickly before we hit that break, what is there on NDTV Profit's watch list? Bandhan, clearly, because two key overhangs have been resolved, and therefore that might spur the stock in the session today, despite the fact that it's an F&O ban. Watch out for that one. IREDA, 30% plus growth on revenues and profitability could be an interesting one. There are some misses, but by and large, in line or better than expected. Adani Enterprises, the QIP of $500 million completed successfully and oversubscribed with quality names, could spur the stock today. Did move up in the last few minutes of trade yesterday. And Anand Rathi, strong 57% growth on AUM and nearly 30% growth predictable on revenues and PAT. So continue.
It's become the next HDFC Bank of our times.
Yes.
30% quarter on quarter. Oberoi Realty, they've approved fundraising plans of 6,000 crores. Watch out for this one in today's trade. Endurance Tech, they've got an approval for a greenfield project, rather the investments on that is to the tune of 300 crores. And Tata Elxsi, it's an expensive stock. Results were muted, guidance was strong, but watch out for this one too.
All right, what's not working too much? Cipla might see some pressure today. Competition emerges in the product, which contributes to 6 to 7% of EPS. That's a pain point for Cipla. TCS, there's a miss on margins and PAT. So expect a bit of a rough start for TCS. All right, we'll take a very quick break. But before we get into that break, let's take a look at the implied open. Down in the red, but that gap reducing consistently. We'll be right back with pre-open and more. Stay tuned.
Back with India Market Open right here on NDTV Profit, and the pre-open rate's about to kick in about 13 seconds. Now, expected to be a quiet kind of a day. The point is specific pockets, and a lot of specific pockets might have moved. Sectorally as well, you would have Pharma being very active, maybe IT being a bit active as well, because TCS might, who knows, drag some of the bunch along with it. The key is only to see if there is some bottom buying happening from those levels or not. So keep all of these factors in mind. Now, we've spoken about some of the specific pockets. What we haven't done, Kush Bora, is talk about the Nifty. So would love to know, is there a trade on the Nifty this morning?
I was kind of hoping for that gap down. The reason being, that would have made the long trade on Nifty that much more effective. With us opening flat around the 25,000 mark, then maybe not. And, the reason for that is that, we've had 4 higher lows, right, for the 4 sessions on Nifty, in fact on Bank Nifty as well. Now that is suggesting that on the downside around that 24,700, 24,800, there is support, there is buying kicking in. So if you do get that 50, 100 point dip during the day as well, with the 24,700 kind of a stop loss, it's not a bad idea to go long. Also, one more supporting data point is that the 25,000 put on the monthly, on the weekly expiry has a very strong base. If that doesn't shift, then if you see that dip, I think you'll perhaps see further addition and Nifty come back to the 25,000 mark and move higher. The cause of concern, the bigger cause of concern, as you've also rightly pointed out in the opening comments, is that there is a lack of momentum. Now, that's because we've not seen a higher high formation on the candles. Once 25,200, 25,250 is taken out, I think that's when the momentum will kick in on the Nifty. So Nifty is a buy on dips at the moment. Strong support zone around the 24,700, 24,800 is to be respected. Any dip closer to those levels should be taken as a buying opportunity on the Nifty.
What about Bank Nifty, Kush? How does Bank Nifty look at this stage? Yesterday it did okay in trade, managed to close about 51,500. Yep. But we've still not, we touched Wednesday's high but could not close above that. Do you feel like this momentum on Bank Nifty in a fresh long even at these levels is warranted?
Like the jalebi fafra conversation we were having.
What Nifty. Are you talking about, Krishna?
in the break.
In the break. So the Nifty is like the fafra right now holding fort, but the sweetener, the kicker is actually coming from the Bank Nifty, where we are seeing that divergent. We're seeing that divergent move on the positive side. Intraday, very strong moves. Here too, the higher low formation is there. Higher high not there, but the momentum is definitely there. Now the 50-day moving average, which is close to the 51, 536 mark, we've closed just under that, is acting as a resistance, and I'll probably take it a step forward, 51,800. Once that is taken out, a move towards 52,500 will come in. But that said, we've been constructive on the Bank Nifty for the last 2-3 days. That's been playing out very well. In fact, one trade that's played out very well is what we spoke about a couple of days back, which is the HDFC Bank trading range, 1,600 to about 1,750 odd, right? The stock is up to 2.5% from the discussion that we had. So I think that trade is playing out beautifully. Now, as long as HDFC Bank continues to respect that and move higher, I think Bank Nifty will also move higher. So more constructive on Bank Nifty than Nifty. Here your positional stop loss comes in at the previous day low, which is close to 51,000. The key level to watch on the upside is 51,800. Once that is taken out, momentum kicks in.
You've shared your stock ideas, Kush, already?
No, I haven't.
Okay, can we do that?
Sure. A couple of them, and since we're seeing a lot of action in the broader markets, both picks happen to be from that space. One is Ram Ratan Wires. Good consolidation, good breakout, but the momentum continues, and we've seen volumes piling on, as the stock moves, stock moves higher. So from a near-term perspective, 755, 780 are your targets, and 705 is where you place your stop loss. One stock that makes a comeback is Orion Pro Solutions. This stock had a magnificent run, came into a bit of a profit booking, but thankfully on the back of lower volumes, and now we're starting to see a turnaround in this. It's a little early in terms of the reversal, but given the move that we've seen in the past and the volume action that we've seen recently, my bet is that this will continue to move higher and go back to those 2,000 levels positionally. Near term, you're looking at a 1750, 1790 kind of a target, and 1660 is where you place your stop loss.
Those are interesting broader market names. Remember, they're in the cash market, not in the future space, so you want to keep that in mind. Dharmesh, what have you made of those tech earnings? Most large brokerages tracking the sector and the stock have not been too impressed with TCS. Tata Elxsi has done well, but it's an expensive stock. How would you approach the whole pack really at this stage, and also preempting what the other tech majors will do?
Yes, I mean, that's the $1 million question about preempting what the other tech stocks are likely to report their earnings. I have been quite skeptical on the technology space for the last 2 quarters, and in fact missed the entire run-up, the stock price run-up which has been there. I don't think so that, all the tech companies are out of the blue in the US. The struggle continues, as has been highlighted in TCS earnings. 1-2 outliers can be there, but there's sort of secular trend which is setting in for technology companies catering to the US and the European market, and that's the big question which is there. I think more clarity will come post the US elections are through, and whosoever comes to the power and what's their entire strategy towards this space, and that will determine the further traction into these companies. They have run up quite a bit. 30-35% upside we have seen in the recent past, and that creates an opportunity to book profits. So we were not there in the space, and we won't be there in the space till mid-November. We'll see the earnings play out and see how the US election results are there, and thereafter we'll take a call.
Of course, the view coming in on TCS from Dharmesh. Well, as always, it's 9:05 and it's time to go over to Harsh for the top brokerage calls this morning. Harsh, it's over to you, sir. Citi's got a call in supply, I believe?
Yes, absolutely. In fact, for all of Pharma in focus, we've spoken about that. But basically, they've retained their buy rating, 15% upside from here. They're pricing in some negatives, though. They believe that a Chinese player which has ventured or received approval for the generic Abraxane, which Cipla manufactures. This is adverse to Cipla to a certain extent, also because the Goa facility of Cipla has also received a warning letter. So a couple of negatives starting to get built up. One is, of course, the Chinese player getting approval. Second is the Goa facility receiving a warning letter. Now, a significant market share in terms of the product itself, which the Chinese player currently has. There's going to be likely a decline in price as a result of this. The outcome still uncertain, both with regard to the inspection as well as with regard to how this plays out on Cipla's numbers. But overall, it currently contributes, the product currently contributes around 6 to 7% of FY26 or FY27 rather EPS of Cipla, and therefore likely some bit of impact on Cipla, definitely on the back of both of these developments.
Okay, so Cipla in focus. Let's look at a few of the pre-open rates, and Bandhan Bank is at least having a pretty good day pre-open as was expected. Let's pull up Bandhan Bank pre-open, 7.5% up. Some of the other stocks that we've been tracking, TCS, a tough time after their results were not really up to the mark, miss on margins, 2% down on TCS. What's also interesting is let's look at some of those other result impact stocks, Tata Elxsi. Let's look at IREDA, what they are doing today. And, BSE is also something that I want to pull up. Is there any impact coming in of NSE choosing to dump bank Nifty expiry versus the Nifty expiry may be positive? But then again, BSE is one stock which has just been flying one way or the other. What else is working this morning? IFL Finance is doing well, so is Sterling and Wilson, but some weakness in the tech pack overall. Look at TechM, for example. Look at, for example, a Coforge, or all of them looking pretty poor. But Dharmesh, I want to come to you on Bandhan Bank because it's likely going to be the stock of the morning. You spoke about that earlier, but do you think you look at some of the others in the banking space right now?
Yeah, Tamanna, we are quite constructive on the banking space per se, and I think the slide which we have seen in the last 2 months gives you a good opportunity to get into it. So we have a buy rating on Bank of India for the public sector banking space, Canada Bank, and Bank of India, if you look at it, it's corrected almost 50% from the top. 150 has come down to 105 kind of levels. Same has been the case with Canada Bank. So the quarterly updates were quite strong. Advances for Bank of India grew by 15% and deposit growth was at 10%. So that trend is likely to continue. And from the private sector banking space, I think ICICI Bank should be the topic out there. We are avoiding as of now Axis Bank, SDFC and IndusInd Bank for that matter. My only worry about the space is one is the NIM contraction. That will definitely happen around 20 to 25 basis points we're expecting this quarter. And the other is the slippage part. So that has to be monitored very closely. And there we feel that ICICI Bank, Bank of India and Canada Bank are likely to be better off in the relative terms. And the price correction in the public sector bank does give you an opportunity to go buy rating. So we are looking at buying opportunities on a systematic basis. And for the next couple of months, we are buyers in that space.
So Bandhan is starting off 6.6% on the BSE higher. So that piece of news, part discounting has happened, 7.6% on the NSE. It's a seriously strong up move at the end of the pre-open session.
And this too also, Niraj, when it's in the F&O band.
It's in the F&O band, yeah. So that's the really interesting thing around Bandhan Bank. Some of the others which are seem to
just
be
very quickly on Bandhan, there's a big block that's happened that we will flash in a minute, but 1.8 million shares have been traded in the block. So it's part of the flashes on our internal channel, but it'll be on your screen any minute. So that could be also a reason why you're seeing such a big up move on the stock.
Yeah, but I mean, yeah. So block getting digested easily in the pre-open session as well in the block window. But interesting start to this one. The best performing stock on the BSE 500 is Bandhan Bank. What else? Sterling Wilson, Century Ply, Heikel are amongst the others that are starting off okay. Dharmesh, quickly, Oberoi Realty, 6,000 crore fundraise announced. Real estate, we've seen a clutch of these QIPs happening. Do you guys have a favorite here as a house?
Yeah, we are still constructive on the real estate space, Niraj. And we do think if you want us to go with a basket buy, so Oberoi Realty, Phoenix Mail and DLF are the top picks out there where we are focusing on. And this is for a 1 year kind of a time horizon if you are holding it. So we are expecting around 15-20% kind of a stock price movement. At the same time, I mean, the entire space is in a sweet spot. I mean, input prices have not gone up that significantly. India steel prices are still low. Cement prices have not moved up to that extent. And we are at the point where interest rate cycle may come down. So that will give flip to the affordable segment of the housing and the mid segment. And as far as premium segment is concerned, we have seen the, I mean, the entire boost and the excitement on the booking. So there's no problem out there. So all these three verticals are likely to fire for next 1 year as well for the real estate sector. And any declines has to be used to get into your portfolio buy in these companies.
Okay. Some other stocks that are doing well, aside of Bandhan, by the way, Wokhard is up. Okay. First things first. Transformers and rectifiers up another 5% today. That stock is on a roll and how. But by the way, viewers, you should hear what the management said in the interview to us yesterday. I mean, they are very constructive, and the promoter is constructive on the space for the next few years. He called it a decadal opportunity in his words. So Trill or Transformers and Rectifiers will come up on your screen, up 5% yet again. But the other one, very interesting, guys, is Wokhard. That's up 5% because it apparently has gotten the permission to market nephromycin. And that is what is leading the stock to come back after a brief slumber. Now, it's a dangerous stock to trade, Kush, moves on circuits usually. But what do the charts suggest for Wokhard? I want to ask you about Trill. That I don't need you to tell me that the charts are looking good. What about Wokhard?
No, incidentally, Trill is actually making a comeback. Had a good run correction and then making a comeback. So it's a comeback trade for sure. Wokhard for now, I think should be taken as an opportunity to exit because there are resistances around the 1,040, 1,060 kind of mark. If you do get a move closer to that, then should be taken as an opportunity to sell. Near-term consolidation on with a negative bias. So this bounce is actually a bit of a relief for whoever had a position.
Dharmesh, do you track either of these counters? We caught up with the management of Transformers and Rectifiers yesterday, and the outlook is looking extremely positive. Not just on top line, but they're also gunning for margins of 20% plus. Do you track Transformers and Rectifiers? And also Wokhard, if you've got a view on this one, they've got approval to sell a drug called nephromycin. We'll try and get more details on that. But for now, it treats bacterial pneumonia from what we understand. So on Wokhard and Trill, a fundamental view.
Okay, we have been tracking Trill for quite some time, last 6 months, but unable to, come out with a fundamental note on that. The only reason was the valuation multiples at which it has been trading and the kind of fast-paced stock-based traction which has happened over this period. So otherwise, the company looks fundamentally very sound. They will keep on growing at 15-17% with operating margins getting better and better. But there's a limit to that. I mean, beyond 22-23%, it will be difficult for them to sustain those kind of margins, the space in which the business in which they are. But fundamentally, I mean, the stock's trading at around 100 times PE multiple, and that makes it difficult to justify. For personal portfolio, HNI portfolio is fine. But for fundamentally to justify that for next 10 years, 15 years, a bit difficult. So we have left it. But yeah, a positive, constructive view out there. Work hard. I mean, we have always avoided that, and we continue to avoid that at the quarter. Yeah.
Okay, but that may not necessarily be because of news or otherwise. Dharmesh, of course, is saying that they have not tracked Wokhard in a while and continue to avoid that. But up 5% today. Let's wait and watch if there is more in store next week. But the market's about to start. Remember, IT might drag the indices lower, so that's to be kept in mind. Flattish start. Nifty IT should be brought up next, and very quickly we'll move on to TCS and the big, so 0.5% lower or thereabouts. Let's pull up the heat map and see what's happening with Tata Consultancy Services, and is it dragging some of the others along with it? Actually, it's not TCS but Cipla which is the top loser. The City note speaking about the generic version of a drug, and that is impacting Cipla yet again. So 3.5% yesterday, another 2.5% today. Well, this is very, very strong down moves on this one. TCS is actually not the top loser, in fact not in the top 3 as well, or in or around. ICICI Bank is down, Asian Paints is down, crude prices up, so maybe some of those crude sensitives will be moving a little bit as well. Trent corrects a little bit as well, but it's essentially Cipla and TCS which are the main stocks on the downside, but really not a very strong downside on TCS either. It's largely about 0.5%, where the stock is already corrected about 5-6% in the last 1 month. In fact, wonder if charts show this as a buying opportunity. We'll talk to Kush Bora about it now that we have the opening rates. What's doing well? HCL Tech about 1% higher. Some strength for Hindalco because overnight a lot of base metals have rallied. So we see that ONGC is up because crude has rallied. There's strength in Wipro, HCL Tech, Infi. So everything non-TCS on the large cap space seems to be doing okay. Titan makes a bit of a bounce back. So net on the large cap side, maybe OMC is quiet, but Cipla and TCS, Tamanna, stand out. And of course, what is TCS's loss is a gain for some others.
Is gain for HCL Tech, definitely. That's the mood in the morning, not half bad. Let's just look at the sectoral indices for a second before we get to stock specifics that are buzzing this morning. Metals making a bit of a comeback actually after a couple of down days, but nothing too much. What's really paining and hurting here is the Nifty Finance, realty stocks, Bank Nifty is doing bad. So these have been the winners of the last few sessions. These are the ones which are really hurting today. Everything else very flat and range bound, to be honest. But stock specific, let's talk about Bandhan Bank. Nothing flat or range bound with what's happening to Bandhan Bank this morning. Definitely stock of the day. 2 negative news points turning positive for Bandhan Bank. The stock nearly 9% up on opening. One is the credit guarantee scheme audit that was taking place has got them in the clear. They get about 500 crores odd on the balance sheet right away. Second is that they have a new CEO who has great experience, takes over from 10th November. That is being seen as a positive re-rating from a lot of brokerages as well. So Bandhan Bank to watch out for. Results that have been announced. Let's look at Tata Elxsi, Anand Rathi, IREDA. Street has given a thumbs up to all 3 of them. IREDA as well. Tata Elxsi, Anand Rathi all doing well in trade. BSE I wanted to look at. NSE has chosen Nifty for their weekly expiry. So the Bank Nifty is out. This was anyway positive for BSE when this was announced, but it was not clear which expiry the NSE would go with. Would it be the Bank Nifty or the Nifty? They've chosen the Nifty. Advantage to BSE in terms of a level playing field. The stock is up today. Tata stocks also in focus. Trent, Tata Chem, Tata Investment, and they're having a bit of a rough day. Tata Investment is the only one which was up today after a good day yesterday as well. Tech stocks under pressure. Tech M and Coforge is the one that we're looking at. Well, they seem to, those rates exactly the same. Those seem to be bucking up. So TCS is the outlier over here, which is having a rough morning. But otherwise, not too much buzzing, Samina.
Boring Friday actually on Day Trade. Yesterday we were in snooze mode and we seem to have taking our time to wake up this morning as well. Broader markets are trading flat. The benchmark also not doing too much in trade. Seeing a cut, we are back up below 25,000. So that's now turning out to be quite the level of resistance on the bulls to maintain on a sustainable basis. Well, there are a few stocks that are looking weak, so I'll highlight the losers before I go into the NSE, the Nifty 500 gainers. Cummins is down 4%. That stock's looking weak. IFCI is down 2%. Cochin Shipyard, after a sharp up move yesterday, is seeing a cut of about 2% this morning. Pharma names like Cipla continue to see some weakness. There was a Citi note on Cipla as well. Tata Teleservices down 2%. KC, Hutco, railway companies, stocks like Vodafone, Idea back on the sell side. Oberoi had a successful completion of its QIP. The stock is still trading lower, down 2% as we see it. You've also got fertilizer names that continue to see weakness in trade, despite the fact that a whole bunch of those fertilizer names are currently trading in the F&O band. On the gaining side, the list is being led by Bandhan, which Samina has already highlighted for you. The stock is up 8.5%, followed by Tata Investment Corp. Page Industries, I don't know whether we highlighted this one, but it's having a pleasant day, 3.5% high again. Part of the group as well. Usha Martin looks okay. Gujarat Ambuja Exports is trading firm. Blue Star 361 VAM is also having a pleasant day. Well, a quick check on how Anand Rathi is doing, whether they've picked up any steam post that earning reportage. It was largely in line with the street expectation. Yes, the stock is up 4%. Along with that, 361 VAM is also looking good on anticipation that the good earnings from Anand Rathi could be an indication of what the sector has to offer in this quarter. So that's how the markets look. Quietish, but it's Cummins that is leading the gains today, and so is Bandhan Bank. So both those counters having a good trading session. Cummins on the downside, of course. But Kush, anything you've identified? I think the day belongs to Bandhan, and Anand Rathi started off marginally higher. Now it's turning out to be the top biggest gain on the Nifty 500, nearly just over 5% on Anand Rathi. A quick buck can be made. Any long trades for intraday?
Very likely on Anand Rathi, because you see the move, and the volumes are actually quite stupendous. Whatever it was for the whole day yesterday, the volumes are equivalent to those in the first 5-6 minutes of trade, and so this is a good volume backed move. There's a possibility that the stock could head to 43.50 kind of levels also. So yes, from an intraday perspective, there is still some money to be made. It would appear so. Bandhan Bank is giving up the initial gains that it had made, and the 200 resistance or the 200 level resistance is perhaps acting up. So I wouldn't suggest any fresh trades on Bandhan Bank after this kind of gap up opening. You might want to just give it a day to see where it settles. Just a couple of quick updates. We've been talking about Pharma, and Strides Pharma has been our pick for some time now. Yesterday, we sort of revised the targets upwards for towards 1555 and 1590. On opening, 1555 is hit. The stock is sustaining very comfortably around those levels. So if you've got a position, you might want to hold on to this one with a trailing stop loss. And Crompton was a BTST idea where 446 was the first target, and that was hit. So if you did have it as a BTST, I hope you got a chance to sort of exit at the target levels. One other stock that is now starting to look interesting is VA Tech Wabag. Good opening, volumes are fairly decent, and after a brief round of consolidation, this is on the way up. From a near-term perspective, 1510 is the target, 1600 and higher are the levels that you want to look at. This is more of a positional bet.
Sansera Engineering is up about 2.5%. The QIP was launched today. The belief is that the demand is pretty strong out there, and that stock is doing well, 1625 and counting. So keep an eye out for that one. As we speak, Adani Enterprises has moved into the green, so 3180 odd for that one. So keep an eye out for that stock as well in the session today. And we've already marked what's happened to Wokhard and some of the others. But interesting move out there on Sansera. Dharmesh Khan, do you track this one? And if not Sansera, any other auto ancillary name that you guys are constructive on?
Yeah, Sansera in particular we have not been tracking, but in the auto ancillary space, Craftsman Auto looks quite interesting to us, and JBM Auto. So these are the two companies where we are constructive on. JBM Auto primarily because of its split between the auto ancillary part and the EV bus part. Both businesses are doing quite well. Though price-wise, multiple-wise, they look expensive, but I think it is a long distance to go. So these are the two companies where we are constructive on. But just to put in a line more, in the entire auto space for this year, next 6 months, next 2 quarters, we are not very constructive on. We see profit taking happening out there in that space.
Okay. Kush, what would you do with any of the metal counters today which are showing some resurgence? The Nifty metal actually nearly 1% up. So if there is anything that is moving upwards on a otherwise, I won't say down day, but a little bit of a range bound and lazy day, it is metals, Nalco, Hindalco, all of them moving. Anything you like there?
On a rebound, Tata Steel is looking interesting. Hindalco too has had a good move for the last 2-3 odd sessions. However, we know that their fortunes are linked to whatever news comes out of China, and the volatility, big volatility on these stocks continues. But again, if you've got the heart for it and the right risk management systems in place, then perhaps you could consider a rebound trade on Tata Steel, where this near-term, medium-term support zone of 156 is going to act as your stop loss, and on the way up you're looking at a 165, and once that is taken out to 169 as a target. Hindalco very beautifully had respected the 20-day moving average, even on the way down, consolidated there for a couple of sessions. So this too can be considered as a rebound play. 725 is your stop loss, and you're looking at a 750 and a 765 on the way up. So Tata Steel, Hindalco, they could be considered in the metal space.
Okay, so Tata Steel, Hindalco on track. Thank you so much, Kush. Thank you so much, Dharmesh, for joining us today, and happy festivities over the weekend to both of you and, of course, your families. All right, let's move on. Gautam Duggad is joining us now, Head of Research at Motilal Oswal Institutional Equities, and we're talking to him about what Q2 is looking like. Gautam, hi, great to have you on. Let's start.
Good morning.
Good morning. Let's start with the numbers that we have seen. Of course, we'll review sector-wise, but let's start with are you disappointed with the way things have started off with TCS?
Not really, Tamanna. Yes, it's a bit of a dampener on margins, but I think there can be some segment-specific reasons for it. On the contrary, we are very excited with IT. We have doubled down our weight. We used to have underweight till April, and July made it overweight, and now in this quarter's revision of model portfolio, we have further increased our weight in IT. However, we don't have TCS in the model portfolio. We have Infosys, HCL Tech, Persistent, and Coforge. But yeah, we are significantly overweight on IT now. In an overheated market, we think IT provides a lot of stability top down. At the same time, from a bottom-up basis, the narrative around IT will improve in next 3 to 6 months. That's our view. And relative valuations in the context of the market are still quite reasonable, given the kind of balance sheet cash flow characteristic this companies have over the years demonstrated in terms of almost, on a combined basis, if you look at last 6-7 years, cumulatively, they've returned 80% of total, profits to shareholders through buybacks or dividends.
Mm-hmm. Okay. So, Gautam, good morning. Niraj here, what's the base case assumption for Q2 on IT? Are you even thinking of Q2 results, or are you more focused on what they say about what will happen in Q3 and maybe Q4, because by then the US election overhang will be truly out of the way?
Sure, Niraj. So when we upgraded IT to overweight back in July, we just upgraded it basis our construct on valuations. The risk reward then looked very attractive. We've had underweight on IT for more than a year. In fact, almost 2 years. We thought situation is now reaching a stage from where risk is less and reward is more, especially in large cap, because mid cap anyways has been doing well, given the good growth differential which has lasted for such a substantially long period of time. Niraj, if you look at last 20 years relative valuation chart of mid cap versus large cap IT, you will find that in the past, every 2 years, mid cap IT used to slip into discount and then go into premium. In this cycle, for last 4 years, the premium of mid cap IT versus large cap IT is sustained. And I think one of the reasons is the big growth differential that mid cap IT is demonstrating. So our view changed particularly on large cap IT in July, which is where we thought in a market where every segment, every sector is looking a richly valued X of financials, IT offers a reasonable risk reward construct. We didn't expect any significant improvement in operational performance immediately. So to that extent, you're right. I think the numbers and the rest of the operational commentary should start looking better as you move into December and March. But our call was predominantly led by relative valuation construct on IT.
Okay. So, Gautam, the other question is really, and just rounding off this question on IT, the commentary that we hear is that we know that ER&D will perform well, but it's expensive. Large cap IT will have a sluggish Q2. Maybe the commentary ahead might be constructive mildly, that things are picking up, but no definitive moves there. And thus far from TCS and LXC, we've kind of heard the same. The commentary is very good from LXC. The commentary is reasonably okay for TCS. where do you park your money? I mean, what is the first amongst equals? Is it mid cap IT? Is it large cap IT? Or is it ER&D?
No, of course, see, Niraj, IT sector is still predominantly large cap heavy. If you split the market cap of IT sector and profitability, roughly 90% of the profits come from top 5 or top 6 IT companies, which are basically Nifty IT companies. All the other IT companies put together, mid cap, small cap, everything, contribute just 10% of the total profit pool, but they're growing very fast. So, for example, I agree that mid cap IT is expensive, but they were expensive at 1/3 the prices too. You go back a year and a half, look at how Persistent was valued then. Nobody then said that Persistent is cheap, right? Persistent is up almost, I think, 20x in the last 5-6 years. You can make the same argument for Coforge. You can make the same argument for KPIT for that matter. Look at the numbers of KPIT. In 3 years, the profits are 4x. And our view is that some of these ER&D niche plays, which are a play on very specific category or domain, they can continue to demonstrate stronger growth differential versus large cap IT. So you have to have a blend of both mid cap and large cap so that you're not putting all your eggs in one basket, because large cap IT also offers very strong balance sheet and free cash flow characteristics, which you perhaps do not get in mid cap IT. But mid cap IT compensates that by providing you higher growth. Even this quarter, as per our own estimates, we are expecting Persistent to put 4 to 4.5% constant currency quarter-on-quarter revenue growth. So you have to have a blend of both so that you're not going overboard on either side.
Gautam, let's just go sector-wise, and I want to understand how you're looking at all the the auto companies, because big hopes on festive season are coming in, but are you expecting a little bit of a disappointment this quarter?
Yes. In fact, see, Tamanna, let me go back 2 years. We had a big overweight stance on auto for almost 2 years, which we changed to underweight in July. And we are continuing with that underweight stance. In fact, this year we are expecting moderation in auto earnings growth. And this particular quarter, we are just expecting 7% earnings growth, which will be the lowest in last 12-13 quarters. Do remember that auto earnings have tripled between FY21 to FY24. If my numbers are correct, in FY21, the auto profits in Nifty were 18,000 crores. In FY24, they were 62,000 crores. This year, we're expecting 7% growth. And in anticipation of that, we have downgraded auto from overweight to underweight. Our construct was very simple, that we have a very high base on both volumes and margins, right? And which is what is playing out now. Within that overall underweight stance, we have 2 names in our model portfolio. We've been very positive on M&M for last 3 years. In fact, we might be one of the few houses which has no Maruti in model portfolio. We only have M&M. And now we have added TVS Motors too, right? So we've tried to keep one 4-wheeler, one 2-wheeler. Insofar as 2-wheeler is concerned, relatively they are better off right now in terms of monthly volume progression. If you look at TVS itself, it's one of the few companies in auto universe, or for that matter, the entire coverage universe of ours, which has printed 20% plus earnings growth for last 12 out of 12 quarters. So they've been very consistent. Their monthly volumes have been pretty fine. I agree. That stock is also richly valued, but which is not richly valued today. Any stock which is demonstrating good growth in India is hardly coming at a reasonable valuation. But if this growth continues and this margin performance remains stable, I think there is still more upside to be had, and which is why we've added TVS. But overall view on auto remains underweight for now. We're expecting FY25 to be a very low growth year for auto.
Gautam, hi, it's also Samina joining in. While I'll of course talk to you about the umbrella and the earnings as whole, but from what we understand from your report, you believe that most companies, while expected to show moderate earnings, you've identified 6 companies that are likely to report a 35% surge in net profit. I think SBI Life, Apollo Hospitals, Trent, Bharti Airtel make up that list. You want to quickly tell our viewers, where does your optimism sit?
Yeah, so Trent has been a favorite idea for us for a long time now. In fact, if I remember last row, we extensively discussed Trent, Zomato, and Varun Beverages with Niraj. So any company in India which is demonstrating growth differential in the sector, the market has been very, very charitable with the kind of valuation it has been ascribing to those companies. For example, if you look at Trent itself, they're growing top line at 50 to 60% for last many quarters now. whereas the sector is struggling to grow at 15-20%. Of course, profits have doubled or tripled, and therefore at every price, this stock looked expensive at 2,000, at 4,000 about 10 months back, and now I think 8,000. So as long as growth continues at this pace, I think valuations are going to remain very, very demanding there. But yeah, this quarter also we are expecting very strong performance from trade, and we expect that to get better again in the festive season. Insofar as Bharti is concerned, Samina, I think telecom sector is going through a very different level of consolidation right now, whereas Bharti has demonstrated that in the last 4 or 5 years that despite high competitive headwinds and a lot of flux in the sector as far as regulatory cholesterol is concerned, they've been able to manage their market standing very well. Now we are reaching a stage where ARPUs are also going up, and consequent to that, you're also seeing some bit of softening in capex intensity. So both put together essentially means that your balance sheet and free cash flow characteristics for Bharti will also improve. We think that Bharti can continue to grow well from here as well. But do remember, last 3 years, they've had a phenomenal run as far as stock is concerned. Market cap is somewhere close to, I think, 9 lakh crore now. On that base, of course, you cannot expect stock to double like it has doubled in the last 2 years. But still, given the kind of market share, ARPU, and fading off of capex intensity is there, I think this stock can remain a big part of allocable portfolio. I think for insurers, you don't have to look at PAT. You can perhaps look at VNB, where both SBI Life, HDFC Life are demonstrating good numbers. We had upgraded HDFC Life recently, and now we have added HDFC Life in our model portfolio too.
Right. Just one quick one on cement, and I'm talking about cement because the stocks have also been under tremendous pressure. It seems, Gautam, that they are going to report a 41% decline year on year. I mean, this is concerning, I would imagine.
No, but Samina, this is how cement always behaves. Last quarter was also bad. This quarter is also expected to be very weak, and we are expecting next quarter, which is December, to also have a 30% earnings decline. The concerning thing this time, however, is that the volumes are flat on a YOY basis. This flattening of volumes is happening after a very, very long time. I have not seen a 1% YOY volume growth in cement in the last 4 or 5 years in any quarter, maybe except COVID. So that is more concerning. Second, of course, the price increases that they've taken have not been, holding. So which is creating a double whammy on EBITDA margins. So if you look at EBITDA per ton for this quarter, we are, I think, expecting somewhere about 647 rupees, which is at a multi-quarter low. Now, the hope is that at some point of time in this year, around March, those numbers will improve. But at the moment, we have zero allocation to cement, and we're expecting a very weak quarter across the board for all cement companies.
You are not buying into the valuations of some of the cement names because a lot of those have been flatlining now for not just quarters but years as well. And with all these development projects that are announced in South, right, Amravati city, etc., specific pockets of cement, even that is not attractive enough.
No, so they would definitely be attractive at some point of time, Niraj. However, we are in a market which is performing market. So you have to be very cognizant of your capital. You cannot have a dead capital sitting in your portfolio for a long period of time. I'm not saying we cannot make mistakes, but all I'm saying is the attempt is to try and find ideas where the growth is looking good, and we've been growth investors. So what we are trying to do is that whole theme that you said on infrastructure, we're trying to play it through multiple other names. Like real estate, we've been having a huge overweight, which we are continuing. We have a big overweight on industrials. Now we've also added Dixon in our model portfolio. We continue to have ABB. We've also increased weight on L&T, where the valuations have become far more attractive now. But cement with 30-40% kind of an earnings decline, which is visible right now and even for the next quarter, I think you might get better price or you might get better time to buy those stocks.
Okay. So, Gautam, here's therefore the question. If the earnings season shapes up exactly as your note has penciled it to be, you know what, and let's assume that the prices don't move too much from where they are currently. Where is the best bang for the buck? Where is the best value and growth proposition within the coverage universe?
So I think there are two segments, Niraj. I hope that market remains or rather consolidates for some more time, because we've had a phenomenal run in the last 12, 18 months. More so in mid and small caps, where finding idea is becoming extremely difficult. And if growth slows down, which is what is happening, FY24, if you look at Nifty, earnings was up 26%. Our broader coverage universe reported 32% earnings growth. So that's why last year we were very positive on mid and small cap, because we could see growth sustaining in FY24. This year, growth is moderating from 30-odd%. This year, we are expecting 7% for our broader coverage universe and 7% for Nifty as well. So it is very important for market to consolidate, spend some time in the zone, allow the earnings to catch up. Now, if that were to happen, and let's say we get Nifty at 25,000 again in January or March, then again, valuations, at least for large cap, become slightly more attractive. Even today, large caps are quite fairly valued in my view. It's the mid cap and small caps where there's a lot of problems on valuation. Your mid cap index is trading at 35 PE, which is a 60% premium to Nifty PE. A small cap is usually, if you look at a 10-year average, trades at a 24-25% discount to Nifty, is today trading at a 10% premium. So in this kind of a backdrop, what we've done, one of the big calls we have taken in our model portfolios, we have moved private banks from underweight to overweight, right? So we've increased weight in ICICI, HDFC Bank. We've also introduced Kotak Bank in our model portfolio. We've added HDFC Life. We've added some of the niche alpha plays in NBFC like Five Star Business. We've increased weightage on Angel. So overall financials have gone to a chunky overweight for us, right? And all three segments of financials are overweight: private bank, PSU bank, diversified financials, NBFC. So that is one thing we've done. IT is already a big overweight. So both top down and bottom up, you can say, or rather you can conclude that our portfolio today is slightly more defensive than what it has been. We are, of course, still overweight on industrials, healthcare, but we've gone underweight on auto. And consumption also, we've gone from overweight to neutral now. Some of the high flyers and discretionary names like DMart, Kalyan, we've taken out. We have instead doubled down our allocation on names like Metro and Cello, which have not performed, and which, if the festive season is good and discretionary demand recovers a little bit, with that perspective, we've added further weights in both Metro and Cello. So staples, we are underweight. We still have only Hindustan Lever in staples. So that's how we are trying to juggle around in this kind of a market where valuations are very, very punishing in mid and small caps right now. So in fact, our bias is predominantly toward large cap now. If you look at our model portfolio, 75% of our weight resides in large cap now. Only 25% is mid and small caps.
From your report, we understand you've cut your Nifty EPS for FY25 and FY26, and you believe this is one of the worst quarters you've seen in the recent past. Let's keep this quarter behind us now. When do you think the rebound from the next quarter is a fair expectation for street participants to have, or do you think this quarter is going to be followed by very aggressive downgrades?
Actually, Samina, let me qualify that downgrade by just explaining the nuance behind it. So 4% on a headline basis looks very big downgrade, which it is, but you have to just layer it down and see which are the stocks which have driven those downgrades. So out of the 4% downgrade, 80% of that 4% has come from just 4 stocks, which is Reliance ONGC, Tata Steel, and JSW Steel. The rest 46 companies, there the earnings revision has been very flattish. If you look at the broader markets also for our coverage universe X of Nifty, there are about 225 stocks. There also the earnings revision has been flattish, maybe -1 to -1.2%. So while that 4% number looks a bit, scary, if you see through the details and take a deep dive, it's not a very broad-based downgrade. I know we have seen a cycle of 2015 to 20, where every year we used to see across the board, across the sectors downgrade. So no, this is not that kind of a situation. And we do expect this to change. In FY26, where our expectations are still pretty healthy, we're looking at 17-18% growth. So in fact, Samina, if you see last 5 years of earnings trend, every alternate year we've got a slight moderation in the growth. So FY22 was a 40% earnings growth year for Nifty. FY23 was 10%. Then FY24 again we saw 26%. This year it is 7%. And then again FY26 our expectation is about 15 to 18%. The thing is, when earnings changes, either on the upside or on the downside, are disproportionately led by commodities, the market tends to see through them. when you saw 40% earnings growth in FY22, market didn't get too excited in FY22 because ex of commodities, the growth was still 21% only that year.
Gautam, I'm just going to come to you. Important point you made that 4% EPS cut is being contributed by 4 major companies. And let me come to the biggest of them, RIL. Let's get into a little bit of a detail by what you're expecting in Q2, and is there a bit of worry there? Where is it? Which vertical is it coming from?
So it's coming across the board, actually, Tamanna. So standalone, we have seen that Singapore GRMs have been very flattish QOQ. So there has been change in estimates around that on a full year basis. We've also cut retail estimates by about 8 to 10%. And we've also marginally tinkered around with the geo estimates too, where we've cut by 3 to 4%. So net Reliance itself on an aggregated consolidated basis has seen about 8% of earnings downward, which is pretty big for a company of that size and that weight in the index.
Okay, thank you so much, Gautam, for speaking with us. I mean, it's always fun chatting with you, and we can go on and on, so much more to ask you, but we will see you back for the review of Q2.
Sure.
And we look forward to hearing from you then. Gautam Duggar of Motilal Oswal on what Q2 is setting out to be and could be disappointing for some, but not for the next company that we're talking to. Pradeep Kumar Das, Chairman and MD at Indian Renewable Energy Development Agency, IREDA, is speaking with us today. Mr. Das, great to have you on the show. Your Q2 FY25 numbers are looking robust. So interest income up 37%, interest expense has also gone up 30%, NII is up 52%. Can you tell us what has been the big highlight for you this quarter? What has worked?
Yeah, very good morning. Thank you. So nothing big highlight because we have been consistently growing in this ratio. I think slightly better. If you see the H1 to H1 comparison of loan book, for last 4 years, CAGR of 27%. If you see H1 to H1 comparison of this period, it is in the range of 36%. So that is what a significant factor is there. Otherwise, if you see last 18 quarters, we have been growing phenomenally, exponentially. And if I say tell 18 quarters, that means when we started 18 quarter, the base was low. But every quarter we are setting a benchmark for ourselves. The base we are improvising, but however, the growth ratio, we are further improvising on that. See, the sector in which we are there since 37 years, and the sector is quite exponential now, mainly keeping in mind the 500 gigawatt target of Government of India, with the global commitment what we have given for 2030 of 500 gigawatt of non-fossil fuel installed capacity. Already we have crossed 200 gigawatt and another 300 gigawatt capacity addition to happen. And we are enjoying a market share significantly and will continue to do that. So maybe it sounds encouraging, but I think we are habituated of giving this kind of good performance since continuously 3-4 years.
Okay, coming to your net profit number, it's of course it's looking good, but slightly below what estimates were on the street. So I understand you've been a consistent performer, Mr. Das. I appreciate that. But do you think that you are going to have a better, Q3 going forward? What is the outlook? Are you seeing this growth at a steady rate, or are you seeing an improvement?
There will be certainly further improvement in this. And if you see the track record, always Q1 will be X and Q2 will be X plus Y, and Q3 will be X plus Y plus Z, and Q4 will be X plus Y plus Z1. So that way we grow, and that is the way probably the sector also grows. And if you see the second quarter, most of the projects do not take place because of the rainy season. The construction doesn't happen that way. So from now onwards, a lot of things will happen. And if you see, our sanction has grown quite high in this period. And certainly the execution is going to happen in this quarter as well as the last quarter. So what we had focused earlier, normally in the first quarter used to be lower, but this time we had focused from March onwards that how can we have a Q1 better performance. And our Q1 up to 2425 was best in the history of the company so far. And as I told, because of the seasonal impact of rainy season and other things, So Q2 is not that encouraging, but despite that, since our sanction has gone up, we are quite confident that we are going to further improvise in our Q3 and Q4.
Mr. Das, good morning, Niraj here. What is this impairment hit that you've taken? On what account is it? Or is it a particular sector, particular account? It's a large number.
Yeah, see, not large, very large. So look at the book size of 65,000 crore and cumulative sanctions so far more than 2.08 lakh crores and financing of 1.35 lakh crore. This is 140 crore is not a big figure. See, a couple of old assets were there and we wanted to go to sort out those things. And the impact of those is going to be visible because two things. One, certain settlements were happened, only one account, and a couple of accounts which has gone to stage 3. We are confident that is going to come back again to stage 1 or stage 2 category very soon. Because we are focused also having a comfortable provisioning kind of thing. Our provision coverage ratio, if you see 52, and earlier if you see the vis-a-vis the same half yearly previous year, it was slightly lower perhaps. So therefore, it is not at all alarming. It's 1 or 2 accounts handling those will not be
okay. No, sir. So, okay, I thought the number was 338 crores, the impairment on financial instruments, 338 crores, right? I'm not saying it's alarming. All I'm saying is, what is this, on which account is this? And the reason why I ask this is because, I mean, renewable sector has such a strong tailwind. It's just surprising to see an impairment hit. So on what account is it? And is this a one-time hit or could it get repeated? It's 338 crores, right, sir?
Yeah. See, as you said, renewable, this is an exception. But renewable in the country in last 10 years has grown. But we are carrying these assets since last 37 years. We are 37-year-old company.
Right.
As I told, some of our old assets, particularly the small hydro and bioenergy space, some of the assets were there. And I'm sure this will become an exception kind of thing. This will not become a regular for us.
Okay, so we've seen, just on this only. So we've seen a number of 338 crores. You are saying that a smaller number or another number may come up, but it is not to the extent of 300, 350 crores that we'll see every quarter. The next quarter itself might have a smaller impairment hit, if at all.
I think in last 4 or 5 quarters, if you see, this is just a bigger figure you have seen now. This, as I'm saying, we are confident this will be an exception.
It is an exception and not a rule. Okay, but you still haven't told me, sir. I mean, what account or what sector is it? Can you share that?
Deep down, we'll be sending the information to the stock exchange very soon because we are not giving the details so far.
Okay.
We want to publish what is the statutory information required because you see, we are the only company in India in banking, non-banking space who could report the audited result, limited review result in 10 days' time. So further breakdown information we'll be sharing very shortly.
Okay, fair enough. The other thing which is exciting is the approval that you've received for setting up the retail business for IREDA. Can you explain a little bit about this, Mr. Das? What exactly will you be doing in this retail business? What are the segments that you will be servicing, and what is going to be the impact for your revenues from this segment?
See, almost I think 6 to 7 months back, we had indicated that we have sought the permission from Government of India to have a wholly owned subsidiary for catering to the retail space because we being a project development finance organization working since 37 years, the retail and SME and MSME space, renewable, is not well addressed by the banking sector. So what we had realized there, you look at the Kusum or rooftop solar or other small category of segment, C&I segment, those are not been catered well. And we envisage around 8 to 8.5 lakh crores of business in that space in next 5 to 6 years time.
Number, sir, what is the number? What is the number?
8 lakh crore roughly.
8 lakh crore from the retail side.
Retail side, yeah. That is a rough estimate we have made. Okay. And you see, today our market share is almost 11-12% in renewable financing. And particularly if you see the vanilla area where we have 57% assets, they are by and large banks and other lenders are also coming. but we have around 19% emerging area assets where others are not that comfortable. And we started like ethanol 1.5 years back, e-mobility storage just 6 months to 1.5 years back. And our book size has gone up to 19% in that space. That means in the new and emerging one also, we are having that kind of command in which we had earlier also. So in this space, since others are not coming forward, we have envisaged that huge not only business opportunity, this is also a sectoral requirement. Because this space, they are struggling to get a bankable solution.
So, for example, tell us if this is where you will be lending. The PM Kusum scheme, rooftop solar, EVs, energy storage, green technology, sustainability, energy efficiency, and other B2C segments. Are these broadly the areas which you will be servicing?
See, what is our object or purpose for having a retail one is, so far we have expertise in doing project financing. But we have expertise in understanding and analyzing the new and emerging technology and renewable space. So what we have planned that we can handle the microfinance companies or self-help groups, those who are in aggregator mode initially to cater to them. And in due course of time, we can develop and design strategic partner where our USP, our process and other things will be ours. Only the front end connecting with the market, those agencies will be going into partnership mode. So that front end will be there, back end will be there, our policy, our intelligence, our due diligence, that will be in place. We can go for a franchise model, but that is in the very initial stage. We are envisaging around maybe if you go with a rough estimate out of 8 lakh crores of business, if you go by the normal market share, what we are having around 11-12%, similar size we can get also there. So roughly around 80 to 1 lakh crores maybe could be possible, but we have to have a very different kind of working model for that. With the existing model, we will not do it. And that is the reason we have requested Government of India that allow us to go for a completely different separate setup subsidiary, which will be catering the retail RE space. And we want to make it like a combination of fintech, combination of microfinance and company, combination of project finance like IREDA, and combination of pure retail, whatever is there. And we want to make it a fully IT-based implemented system so that a hardcore retail renewable requirement, whatever is there, we can cater to them.
So, Mr. Das, for all of these plans, what is the funding?
As far as the impairment is concerned, I think it is 3.82 crore, not 382 crore. I think can you please cross-check it? 384 lakhs.
Okay. So you don't think it's a big amount, you're saying?
Not at all, not at all.
Okay. I thought the number, to my mind, as per the release, impairment on financial instruments talks about 338.5 crores. But maybe you're right, sir. Never mind. As long as you're saying that this is not a recurring expense, I don't think the street would be too worried. I was looking at the exchange release, which said 338 crores. But okay.
3.8. Okay. So, in a balance sheet size of loan book of 64,500 crore to 3
point, sir. Okay.
It's a small amount.
Small amount. Okay. Let's talk about this thing, Mr. Das. What about the fundraising for implementing all of these plans? When does the QIP happen? What's the kind of dilution that you reckon you will do for future growth? What's the kind of demand that you sense?
We have received up to 7% dilution, either in single tranche or multiple tranches. We had already indicated earlier around 4,500 crores of requirement by January, February. But now after receiving the retail and then almost our GIFT City activities advanced stage, and we have to start parallelly these two activities. So our fund requirement might go up, but exact amount of requirement will be connecting with the market intermediaries very soon. But for sure, by this year end, maybe by February end, we have to ensure that a fresh equity infusion happens in the company, because the kind of disbursement what we have planned, debt borrowing plan, almost 24,500 we have planned.
Right, sir.
Done.
Right.
So around 5,000-6,000 crore maybe in this space, but that exact amount we'll see after working, and also we'll see the market condition.
Oh, sure, of course. So, but you believe by Jan or Feb, about 5,000-6,000 crores worth of fundraising is what you will probably need to do?
Earlier, our assessment was 4,500.
Now you're raising it to 5,500, 6,000.
It will further go up.
Got it.
So exactly how we have not ascertained.
Got it.
That is why, again, since the 7% is the upper cap given to us, we have to see what is up, because it is a QIP mode.
Sure.
And for QIP, there is a semi mathematics.
Got it.
So then we'll see what best we can do in this place. And again, as far as date is concerned, since our GIFT sheet will be in operation, we'll be also resetting to various green funds overseas. And we'll see that how best we can bring it down the borrowing cost through that.
Got it, sir. Got it. Okay, I do stand corrected, but it's 33.85 crores, Mr. Das. Not 3.38, not 338. It's 33.85 crores, the impairment for the quarter. So, yes.
Even 33 is not a big amount.
Yeah, not a big amount at all. Perfect. Great. Good talking to you, Mr. Das. Thank you so much for taking the time out and being with us today and speaking first to us. We wish you all the best for the quarters ahead.
Thank you. Thank you, Niraj. Thank you, Tamanna. And thank you, Samina.
Thank you. All right. With that, it's a wrap on India Market Open. But up next, we have Talking Points. Stay tuned.
Thanks for tuning in to Talking Point, and it's the festive cheers across the NDTV Profit newsroom. And in line with that, it's just apt that we're talking to the next two guests, because Dussehra is a day of buying good things, from houses to cars to two-wheelers, and therefore great to do a dealer check as to what's happening on the car purchase.
What are you buying today, Niraj? What are you
Dussehra
buying
is
for us as
tomorrow.
well? So what are you buying tomorrow?
Gantia and jalebi.
Good things.
But you know, also important to have this conversation right now, because so many segments and companies are betting heavily on this festive season to actually show some traction.
Yeah.
And the dependence on festive season is always large for a whole clutch of companies, but maybe even more so. So the ground check today coming in from the auto side.
Yeah, just so keen to hear what the guests have to say. So let's start off this conversation with Ajay Agarwal, and he's MD of Trio Tata Showroom. He joins in from Delhi. In a bit, we'll also be joined by Ashish Shukla, CEO of 4 Point Automotive. They trade in Maruti cars. But Ajay, good having you. Thanks for joining in. We understand, as per the data that came out, that until the end of Pitru Paksh, the numbers looked very, very wobbly for four-wheelers. Maybe you differ if you will, because love to know. But we'd love to know, how has the festive season start, or how has the Dussehra or the Dussehra period beginning been for car sales?
Thank you, guys. Thank you for having me here. Before Navratri began, Pitru Paksh was a little stressful for our dealers. We had an all-time inventory with us. But once the Navratris began on 3rd of October, things have been pretty good. The walk-ins improved decently. We have around 2x walk-in compared to same period last month. The bookings improved. The bookings are also, we have a healthy pipeline of bookings. Compared to last year also, we have around 8 to 10% growth in bookings. And as of now, the deliveries have been good. In Delhi NCR, where I operate, we are already close to the Vahan numbers of last month. So I'm very hopeful that by the end of the Dhanteras, when we exit this month, we correct our stock. Customer pipeline is very, very decent. And on top of it, the best thing that is helping us do the volumes is the great offers by all the OEMs. The prices, the offers on these cars are all-time best. In last 1 year, if you see the models that we sell, the transaction price is one of the best that we can offer to our customers.
Ajay, do you feel like a lot of the push or the sale numbers that you've been able to record or anticipating this festive season is on back of better pricing and better offers, or is this irrespective?
That is true. Yes, back of offers and the current schemes offered by all the OEMs is helping drive the sales. And but we see in last 2 months the sales were drastically low. We had degrown last month. The passenger vehicle sales was almost 18 to 20% down compared to previous months. So there was a pent up demand. The customer was waiting since there was so much of news in the market about high inventory levels. And the OEMs offering consumer offers, very, very heavy consumer offers. So customers were waiting also. And now, since the offers are also very high, there is no reason for the consumers to wait. They are going ahead and making the purchases.
Mr. Agarwal, are you seeing any kind of a trend switch, or is the focus still on your mid-size sedan, your premium? Are you seeing any premiumization switch in terms of trends and preferences?
Yes, it has changed. The ticket size is improved. Last 2 years, if you see, the ticket size used to be around 6.5 lakhs. Now the ticket size is around 8.5, 9 lakh rupees. So one, the ticket size has moved. Two, the majority of the cars that we sell today are the SUV, whether it's a compact SUV, micro SUV, premium SUV, C-segment SUV. The sedan and the hatchbacks are definitely going back, is taking a backside. But the major growth is coming from the SUVs and primarily the new launches also.
So Ajay, my final question to you really, it is good to know that the Vahan registration numbers for first 9 days are equal to last month's. The question
almost
is,
equal.
Sorry?
Almost equal to.
Almost equal, yeah, let's put it there. Hopefully by tomorrow, it will surpass that. My question is, do you see this sustaining for the rest of the month, because we are entering the Diwali period, and therefore, will October be an unnaturally strong month, or will it be seasonal in nature and could dip post-Diwali?
See, normally what we have seen in primarily again in North India, whatever we do in these 9 days or 10 days of Dussehra and Navratri, we do almost 2.5 times by Dhanteras. So if you see, the month will be almost 1.72x of the normal months, like for example, I call July, August, September average. So this month will be 1.72 times of the normal months. So October should be very, very good for all the auto dealers.
Just one last point, Mr. Agarwal. What are the inventory levels looking like? Because that seems to be a concern across the industry and for dealers as well. Are you seeing a pile-up of inventory levels?
See, inventory levels are definitely high, but most of the OEMs have come back to the dealers and given the rational targets for October, whereas the liquidation will be much higher compared to the offtake that we plan for this month. So I see a correction, ballpark 20-25% correction in the inventory levels at the dealer point.
Right.
Thank you so much, Mr. Agarwal. That's the MD of Trio Tata Showroom, and helping us get a quick check on what the mood is looking like. Inventory levels are high. That is a bit of a pain point, but initial ground reports are telling us that this could be a good festive season. But the big story on your screen is what we're going to discuss now. Sources are telling Bloomberg that Tata Trust may meet today in Mumbai to discuss succession. And that's going to be the big point of view that everyone has their eye on. Now, while the corporate side is pretty much settled, there's no real question there. The question is what happens with the Tata Trusts. Agam is joining us for a deep dive on the breakup of the Tata family. We're going to come to him in just a second. But Samina, this is a story you've been looking at very, very closely. And what are the stakes here? Let's start with that.
It's quite a maze. Let's start by telling you that, right? It's a complicated structure, and in so many ways, if the focus remains on Tata Sons, the shareholding of Tata Sons is also something that, of course, Agam will delve in more detail. But just to break that down for you, Tata Trust owns about 66% of the board, on the board of Tata Sons, followed by Palonji Shapunji, which own 18%, and you've got the Tata Group firms that own 13%, and the Tata family members and others own about 3%. So the likes of Mukund Rajan fall into that category of outside members or professionals who hold some stake in Tata Sons. Now, while we discuss this in detail about who takes on and what's the next succession plan, remember the succession plan for Tata Sons is not linear. What you also want to remember is that despite Ratan Tata being such a wealthy man, he was never the top richest man in the country. This is because in personal capacity, the number of that worth was about $3 to $4 billion. So what we're trying to understand is who takes on next, and whoever takes on next will really have passive control on the board of Tata Sons. Also, what you want to remember is that all the dividends that get paid out, 65% of that is determined by Tata Trust. There's only 35% that's up to some discretion. But I believe, Agam, are you ready with more on this? Agam, I think Agam is still not ready on this.
But Agam, go ahead. We'll get those graphics on. Agam, you've worked on this story. Just tell us what we can add.
Absolutely. So, well, at the end of the day, as Samina mentioned, about 65% of the Tata Sons is held by Tata Trusts. That perhaps is going to be the most important factor to watch out for, because it comes down to who takes over the position of the chairman of these Tata Trusts. Two of them are the most important. One of them, of course, is Ratan Tata Trust, and the other one is the Rabji Trust. And both of them together hold about 50% of Tata Sons. And that's also the reason why it becomes a little bit more important. But let's not forget that there are a handful of board members who are common in both these trusts. So, if we can actually quickly go through the board members and where that and how things stand there, because there are about 5 names that do stand out. And in terms of those names, we're going to actually consider. Well, let's move on and talk about those 5 names then. There you have it. So Vijay Singh, Venu Srinivasan, J.N. Tata, and of course Nolan Tata are among those common names in both those boards. Meli Mistry and Darius Kambata is also the other one which comes into focus. Let's talk about the family tree then. And at the moment, while there are lots of guesses, all we can do is we can show you what the family tree is all about and which of these members at the moment hold leadership positions in these Tata Group companies. Well, in the family tree, well, we do know that Noel Tata is Sir Ratan Tata's half-brother, and he, in fact, also has, well, 3 other children who are also very actively involved in some of your Tata Group companies. Let's take a look at what each of them does. And of course, Noel Tata is currently the chairman of Trent, Tata International Limited, Voltas, and Tata Investment Corp. Of course, we've seen a Tata Investment Corp run up significantly in yesterday's day of trade. But besides that, he also has, stakeholding in the leadership of Tata Steel and Titan companies. So some very important companies out there in which he's a part of in terms of management. But as I was suggesting, Noel also has 3 children, Leah, Maya, and Neville, and they are also very actively involved in some of these Tata Group companies. So let's talk about that as well. Let's see where each of these stand. Leah, of course, is the vice president at the Indian Hotels Company. You also have Maya. Let's move on to the next slide, where she's associated with Tata Capital, and Noel, of course, is part of Trent. So, well, he's also the part of leadership in Star Bazaar as well. So, a lot of names popping up, but it would be pertinent to highlight that which of the Tata Group family, or rather Tata family members, are currently active. And well, it's going to be a wait and watch as to who actually does take over the chairmanship of those 2 very key Tata Trusts.
Okay, so obviously we don't know what's going to happen yet. There will be a meeting to decide the succession. That's what Bloomberg is saying. We'll keep an eye on the story, but definitely a big one to track right here. Meanwhile, thank you for that, Agam. A quick look at where the markets are at this point, and metals is what's roaring this morning, 1.5% now on the Nifty metal.
Yeah, overnight moves on the commodities, both crude as well as metals today, and China is apparently going to give $283 billion stimulus as well. So metals clearly the center of all eyes. But a quick conversation with somebody who looks at equities very, very closely. Shreyas Devalkar, head of equity at Axis AMC, Johnson right now on the show as well. Shreyas, great having you. Thanks for joining in. Shreyas, we were just talking to somebody on how Q2 numbers will shape up. Very likely will not be a strong quarter. Very likely that FY25 as a year will be pale in comparison to the previous years as well. Are valuations plus that a good enough reason to stay light and maybe not be into high beta names and look at value, or you're still very constructive on markets?
Thanks for inviting. And great question. So obviously the market always is about earning growth, and earning growth in last year has been there has been slowness in the top line growth, but the margin has helped a lot in last few quarters. Now we are entering the quarters where that base effect of margin expansion, etc., is expected to fade slightly, and that's where overall earning growth for the market is expected to be lower. Now, in the context of valuation, definitely valuations are high across the board, barring private sector banks. I don't think there is any segment where the valuations are low. Actually, in last 4 to 6 months, market moved to perceived cheaper segments like IT and Pharma and FMCG as such, but still there also earning growth is not that great. And while we have seen the re-rating in those stocks. So all in all, the observation is large caps are cheap, but with lesser growth. Mid and small cap are way expensive, but with better growth. And in that context, in such kind of market, we have seen that historically it leads to consolidation in the market. That pattern you are starting to observe in last 3 to 4 months in the market also. So I think it will be more stock-specific market than just try to allocate higher proportion to small cap and try to outbid the market per se.
Noted. Shares, I mean, the limited analysis that I've done seem to suggest that this quarter will be a washout. And sorry, I'm talking about the quarter too much. I'm not just asking you to comment on a quarterly set of numbers, but the notes seem to suggest that this quarter will be a washout because cement numbers will be unusually weak. I mean, Gautam Duggad of Motilal was saying that he in his last 6-7 years hasn't seen a 1% volume growth in cement YOY. So it's unusually weak. And then energy will have a high base effect impact. Otherwise, some of the other buckets seem okay. So I would love to understand, let's say, for example, on energy and cement, Are you negative, or do you believe valuations bake in some of the worst things?
Sure. See, as far as these headline growths are concerned, for market are concerned, generally every year in last 10 years, 15 years, there has been some pockets. So if you go back in last decade, there used to be write-offs by banks that used to take the market's earnings down. There used to be commodity sector which used to take the earning growth down. So probably this time now it is a cement and metals or energy sector what you are highlighting. So actually as an investor, then what we tend to look at is, yes, where there is a very high earning volatility and lower earning growth. And now coming back to these two sectors in particular, definitely energy sector has its own volatility. And this quarter's what we have seen, there is a little subdued numbers which we have seen in this energy sector. So we are anyway always, so as a house, we have been always light on commodity sector, and that's where energy sector has been low. Coming to cement sector is interesting. Actually speaking, the volume growth for this sector has been in mid to high single digit growth over a longer period of time. And probably in the recent past, because of various reasons. So in last quarter also, where the reasons highlighted where monsoon, and sometime it is about election was also one of the reason in the last quarter, previous quarter. So there has been some reason recently in cement sector as such. But the sector is also, so long-term growth we have seen is mid to high teen. But major point which is happening in the sector is the consolidation, which is slow, but it is underway. And one should look at this sector from that point of view. It is slow, but it is underway, and that's where there is an opportunity in this sector.
Noted. The conundrum, and because you guys have done the traverse, right, Shreyas? Until 2020, you guys were famed for holding on to stocks which were the really high valued stocks because you bet on growth, and it paid off beautifully. In select pockets, the market seems to be doing that yet again. I mean, I'm using the names as an example, not for asking you to comment, but a Trent or some of the others, right? Consumption-led names, some other pockets wherein the market is betting heavily on growth to continue and therefore willing to pay a premium, some EMS names, etc. How do you view the richly valued sectors? There are 3 or 4 out there, all of them different from each other, but I'm just using valuations as a common thread here.
Sure. Even so, would try to correlate with the current exuberance in some pocket of the market to even 2019. There used to be some pocket where there used to be very high exuberance. The broader point we try to look at is what is, first of all, since we are starting on the valuation note on a relative basis. So versus 2019 and comparing to now in 2019-20, probably the relative valuations were too high. Basically, one pack of market was trading at 8 to 15 or 20p, while the other pack was trading at 50, 60, 70p. The difference today now is if this pack is trading at whatever 50, 60, 70, 80p, even part of capital goods, part of actually some of the themes in power sector, etc. They are also trading at 30 to 60 times P. So that relative trade relative valuations is probably what is different today than what it was in 2019. Now, when we look at this, there are always the general sort of rule of thumb per se, but whenever any company's valuation go above 40p, then generally it goes in a zone where that company need to do 2 things to create wealth over a period of time. That whether the orbit of that company is changing, whether the total addressable market is changing. That pattern was shown, that pattern is shown by multiple companies. Some of them, they're there. And if you look at if that pattern is there and they can repeatedly do it, then they end up creating wealth even if they are highly valued at a point in time. So we have seen companies, they are replicating formats after format, the same success story. So that replication in multiple business models is where the real crux comes into the picture. So this is what we tend to look at when we look at expensive valuation. At expensive valuation, the bigger risk or the biggest risk I would call out is the disruption risk always. Because disruption may be because of some loss-making business model come up and then it becomes successful. The disruption may be maybe because of technology or anything. One need to be very careful of that. So if the disruption is there, then that expensive valuation just is troublesome. And the second part is obviously the earning downgrades, but that is applicable to any other companies, not only expensive companies. Earning downgrade, but then it has generally disproportionate impact on the stock prices. So generally, we tend to look at these three parts. One is whether the TAM is increasing, whether they are able to replicate their success story, what they have done so far. And on the other hand, whether there is a technological disruption, there is a competition who is coming, which is at the beginning appears to be irrational by way of entering as a loss-making strategy, and then earning downgrades. So one need to be careful about these things.
Okay. Where is the Shreyas that you are negative on? I mean, in terms of the reallocations that you would have done in the last quarter versus the previous 2 or 3, where is it that you are the most not constructive on, if you will, and why so?
So if you look at across our funds, we are generally underweight on financial lenders, I would say, rather than financial services. The lenders part of it is broadly we are underweight on. Then we have always been underweight on the commodity part, which is metal mining as such. So it is not as such today, and obviously energy part, which we discussed earlier.
Okay. Just wondering, would the, just one last question, 60 seconds, but would the private banks feature in this list as well? Because the opinion out there is starkly divided. Are you not so constructive in private banks?
So when I said underweight on lenders, so yes, we are underweight on lenders. Now, when it comes to private bank, as I highlighted earlier, that is the only pack where there is no re-rating on a 10-year basis. So in FY14, FY19 and FY current valuations are broadly similar. Actually, there would be in some cases de-rating. So valuation is definitely in their favor. But there, what you are noticing is the growth has come down both on the credit growth front and deposit growth front. So one need to be looking into it in more detail. Other part is the NIMs, which also is expected to contract. And so overall on the banking sector, or then I would call it as the overall lending sector. So important part has been the credit cost. So there has been an element of increased credit cost on the retail credit front, because that is the only part which has been growing fastest, right? And there has been some credit cost increase which we have seen in last few quarters. So to be constructive on this sector, one need to be watching out for credit cost coming down and retail credit growth expanding.
Okay. Shreyas, so good talking to you today. Thank you so much for taking the time out and being with us. Really appreciate your time.
Thank you very much.
And that's about the time that we have on this edition of Talking Point. Thanks so much for tuning in.